Hello, everyone, and welcome to our live event. This is the first time we've done this. We're really excited to be here today. I'm Roger Michalski, publisher of Eagle Financial Publications, and today's event is 6 ways to create fourth quarter fortunes. And we're going to kick this off today with a panel discussion. But before that, I just want to mention a couple things. One, right below the video, hit the subscribe button to subscribe to our YouTube channel. We just launched this a little under 2 months ago. Lots of great information. We'll have at least one new video every week there for you. And we actually have lots of new ideas that are coming down the line. So make sure you hit that subscribe button right below the video to subscribe to our YouTube channel. And if you want to ask questions throughout this day's event, you can put them in the comment section. I have this up on my screen, so I'll be able to, see what the questions are and portray them to our panel or our speakers, depending on, when you ask the question. And you do have to be subscribed to our channel to comment. And also, I just want to, just say that all our thoughts and prayers are out there for everybody today. And they're going through the hurricane. Mark is actually down in Orlando right now. We weren't too sure whether he was going to be able to join us or not, but he is here. But obviously, our prayers are with everybody, and hope everybody stays safe through this hurricane. And finally, before we start the session, we're going to have some special promotions for some of our products today that are special for this first time we've done an event like this. So stay tuned for those. So first of all, we're going to start our first panel, and the panel is called The 5 Factors Affecting the Stock Market Now. And we've got all our Eagle experts here. We got Bryan Perry, Jim Woods, John Johnson, Mark Skousen, Bob Carlson, and we're looking forward to a great panel here to kick everything off today. So let me just start with a little overview of some things that we're going to cover in the next 40-45 minutes. A lot of things affecting the stock market now. Look, we have inflation that's 8.3%, but you look at food's up over 11%. Used car prices are up 35%. New car prices are up 12%. I can go on and on. We've all been seeing all the prices going up everywhere. And yet consumer confidence index has risen the last 2 months in a row. Kind of interesting. But yet at the same time, demand for goods and new houses are falling for the first time. At the same time, consumer confidence is going up. Home prices fell for the first time in many years this last month. And oil prices have been falling as well. So lots of mixed things going on right now, which is probably leading to a lot of confusion out there. So let's start with inflation. And I'm just going to throw it out and we're just going to start a discussion. So guys, just jump in whenever you want. But inflation, let's hit that first. So when will the battle with inflation be won, and how? And also, one other question, is inflation actually higher than what the government's telling us it is?
As far as that last question, I think that pretty much anywhere you look, they say if you compare it to the 1982 calculations of inflation, it is higher than they're showing today. I think there's others here who can talk to it more than I can, but just in my study of it, it's pretty fluid what they take in and out of the inflation calculation as far as what the government put in it. And it's very different from 40 years ago, which would show a much higher inflation rate than what they're saying the CPI is right now.
Yeah, there's a few things that need to be touched on. Certainly, the Fed is in control of some things, but they're not in control of other things. And we'll get into some of these topics here, like supply chain and commodity risk and geopolitical issues out there. Certainly wages now is something that they're targeting that, but can they, that's like trying to jam toothpaste back in the toothpaste tube. It's out there, and there's more talk of higher hourly wages going forward here. So that's very sticky, and commodity prices are coming down across the spectrum, but they're still considerably elevated, from a year ago. That's something that's out of the realm of what the Fed can actually do there. That's hard to drive down demand for food. And certain elements of that are also a function of supply chain issues. They're targeting the housing market now. That's obvious. After they've already targeted, they pricked the asset bubble here in the equity markets, and now they're going after housing. So that again, from COVID, there's a supply shortage out there. You saw a mad dash for new home sales in August, and people were kind of panicking. They saw rates starting to gap higher, and they jumped in there. Now we're starting to see those numbers really taper off. So, like you said, Roger, the consumer confidence is pretty good because job market's still tight. We saw that this morning in the claims number was hotter than expected here. So the Fed has more work to do. And Ken Griffin, who was on yesterday at the in a big conference in New York, said I think he's very, very insightful, saying that the Fed has to reset inflation expectations, meaning they're not done yet. And with that in mind, you've got because people go into negotiations for wages and unions and all that kind of stuff in there. If their expectations of inflation are up here, they're going to continue to drive negotiate for higher wages going forward. And it's just a major component between that and housing. Those are the two big ones.
Yeah, I think that's true. I think people underestimate the housing component, and also, Roger, you mentioned the 8.3%. Well, the core is the thing that's really important. And the core CPI was even much higher than expected, even though the headline CPI was actually a little bit lower than estimates, still super high. But I mean, the Fed's targeting a 2% inflation. That's their target goal. And we're like 3-4 times that level right now. So they're not done hiking yet. We all know that, but I think people got way too ahead of their skis and got very optimistic, thinking that there's going to be a Fed pivot and inflation's under control, and the Fed has reached peak hawkishness. And these are some of the things that I've been writing about for the last couple of months, and pointing out that what you want to have happen, or what the optimistic part of the market wants to have happen, is often not reality. So stocks got bid up a little bit on the hope of something, but then the reality kicked in, stocks came right back down. So if you're looking for inflation to be the savior of this market, it's not there yet.
Right, and investors have been way too optimistic this year about it not taking much to bring inflation down. Even now, inflation expectations are still pretty low. Markets still indicate we're going to bring inflation down without a recession, or without much of a recession. But really, much of the inflation is demand driven as a result of the Fed just increasing the money supply too fast. It's finally realized that mistake, and now it has to reverse course. And the question is whether the Fed officials are going to maintain the course and follow up on the strong words they've been saying the last few months, or once the pain really hits the economy, when demand really comes down, people start to lose jobs, is the Fed going to give up and accept a modest inflation, lower than we have now, but higher than its 2% target? If it does that, then we're going to be stuck in a stagflationary period for an extended time. But if the Fed sticks to what it's been saying, it's going to take a lot of pain across the board to bring inflation down. When you look at those detailed inflation numbers, higher prices are in there across the board in goods and services. It's not just a few select areas that have supply chain problems or other issues. It's across the board inflation, and it's going to take significant action by the Fed to reverse what it did in 2020 and 2021.
We have a lot of, if I could just kick in real quick, because one of the mentions was commodities, and there's a lot of, in Europe, they're shutting down their zinc, their aluminum smelting, their steel plants are shutting down. And yet, we see commodity prices low. Well, one factor is that the dollars have been so strong as money flees Europe to try to find something a little bit more stable. And it's been pushing the dollar up, and that's been helping suppress those prices, even though we're seeing supply issues, and we'll get into this later, become an issue because they're all tied in together. And I think I think people are being fooled by that as well.
So
Well,
Mark, why don't you,
gentlemen,
Mark, why don't you
Yeah.
jump in here? And then I'm going to remind everybody, if you want to ask a question, go into the chat box and ask a question. And then Mark, to talk about inflation, but let's also start talking about the interest rates and how much longer do we think the Fed is going to keep rising rates, and how high do you think they'll get?
well, Roger, it's entirely appropriate that I am the final person to make a comment on this, since I'm the most experienced veteran guru among all of you. Have been around a lot longer than any of you, I think. So you're all youngsters, so you need to know what is really going on. So pay attention.
All right, take notes, everybody.
First of all, I got to say, Jim, I don't know what that background is on your screen, but that is really weird. I don't know what that is.
It's a studio tile mosaic, Mark.
I see. I see. Yes, yes. Well, I wanted to have the hurricane in the background because I think we are facing a financial hurricane. This is what I just sent out a Skousen Cafe on this for those of you who get my free e-letter. Are we facing a financial hurricane? And I think the answer is yes, we are. And primarily because the Fed really is just guessing. They're engaged in guesswork, and they have a tradition of overzealous response. We went through a 10-year period of easy money, of zero interest rates, and you can't do that without creating structural imbalances in the economy. We see so many areas where bubbles were created. We saw this in the tech sector. We saw this in real estate. We're seeing it we saw it in Bitcoin. There's all kinds of these bubbles that have to be popped. And so if you look at a chart of Federal Reserve assets and money supply growth, it goes through the roof up through 2020 with the pandemic, and then has collapsed. And so the money supply now is stopped growing, or growing at 5% versus 40% just a couple years ago. So we're talking about an extremely volatile situation, going from fighting recession to fighting inflation. Jay Powell, he doesn't understand monetary aggregates. He himself says Milton Friedman is passé, that money supply doesn't matter. He says we don't know if we're in a recession or not. How can we tell?
How did he get his job then?
At least he's being honest in that respect, that he really doesn't know what he's doing. And you're right, he's going around shooting and popping the stock market bubble, now the real estate bubble. And what he doesn't understand is that the dollar is so strong because you mentioned interest rates. So the Fed is kind of leading the way among central banks to raise interest rates, and he's kind of channeling Paul Volcker, and he thinks he's another Paul Volcker. But remember, even Paul Volcker, after raising interest rates to 21%, by the way, which is crazy, there was a Mexican debt crisis that hit in the summer of 1982. I think this was before any of you were born. And I'm just kidding, of course. Maybe applies to Jim, but I remember that, and the Fed quickly reversed itself. So I think it was Bryan or one of you saying that that the Fed at some point is going to panic in the opposite direction, saying, "Oh, we've gone too far, and now we have to loosen up," and so forth. And it's the insanity just never quits. So I'm predicting that the Fed is overreacting. We're going to have some kind of a crisis that will develop sometime between now and and 2023. That's what my prediction is. They're I think they're just struggling with how to do it. You know, they're looking at the data and so forth, and they're not looking at everything that we're looking at.
And the Fed always overshoots, and they always start too late, and they always end too late. And I think it's just a structural issue, because you cannot peg human behavior the size of a global or a US economy. It's just impossible to manage individual behavior like that. And central planners have been trying to do that throughout history, and they've always failed.
I think I've laid out a good grounds for the question, why do we have a Fed? I think listening to y'all talk, it comes to mind. They always do this, they always do that, and it's always the wrong thing, it appears, from what I'm hearing. It's interesting.
And, you know, one of the things that should be pointed out is that the Fed, I mean, this talk by Ron Paul and others to end the Fed, it's really not going to happen. The reason it's not going to happen is because there's too much power. The government's not going to give up that power to control the money supply and control interest rates. And now they're engaged in quantitative easing. They've added the third sector. And that's a real problem, because they have on their balance sheet these trillions of dollars in mortgages and treasuries. And if they try to sell them off, which they're trying to do right now, they're doing it very slowly. That's going to put pressure on downward pressure on these assets. So deflation is a threat. So it's a real conundrum that they face, but they're too powerful. We're not going to get rid of the Fed. That's I think we're naive if we think that can happen.
I also, too, just one last point on this issue. It should have been no surprise to anyone that when we had a huge 10-year bull market, because there was zero interest rates, I think Marky brought this up, and then once the interest rates started being hiked, way overdue, by the way, that the market pulled back. I mean, it's like being surprised that, you know, your car stopped when you ran out of gas. Just, this shouldn't be a surprise.
Well, is anyone really surprised? We all knew that tech stocks could fall in half and still have decent valuations, right, John?
Point of
Absolutely.
happening, you know, you have we had an event happen here, I think to Jim's point, and until something happens, until something breaks. In the Bank of England, as we saw yesterday, stepped in because their 10-year gapped to 5%, almost like immediately. You had pension funds freaking out. They're calling the Bank of England to do something. So what do? They pivot. They go from quantitative tightening back to quantitative easing for a temporary period through the middle of October, which we don't know if that's going to. I mean, they had to stop the gap of what was happening in the bond market here and rescue the bond market there temporarily. And if you look at the charts of the euro, the pound, the kroner, the yen, the yuan, they're all just very, very bearish charts. And going back to the years of Ronald Reagan and Paul Volcker, they went in and they actually sold dollars and bought Forex. You know, they bought currencies to stabilize the currency markets. And that's not happening here. Steve Forbes brought that up the other day in one of his messages. And I thought that, you know, that was very astute on his part it's a different world now, but that type of tool, when the Fed says they're going to use all their tools in their toolkit, that's something they can do to help stabilize the dollar, is to sell dollars and then buy other foreign currencies, because that is, most other foreign debt is denominated in dollars, and they're getting crushed on, you know, having to make interest payments against these currency dislocations. So that's just something there where you wonder, is the Fed really using all their tools? I don't believe they are, and they could help stabilize and bring the dollar down And that maneuver in itself would really help the equity market stabilize here in my view.
All right,
I
so
think,
let's,
well,
I'm gonna-
one last point, Roger, on because it brings into the issue what Brian just brought up about the UK. That is one of the most curious and easily identifiable mess ups that you could ever have. You have the Truss administration there, which is the prime minister there, new prime minister, decided to send out fiscal stimulus to the citizens because they, higher energy prices coming in the winter. So basically, they're handing out free money at the same time. The BOA, the Bank of England, is pulling back because they're trying to fight inflation, just like the rest of the central banks around the world. And meanwhile, you're getting huge stimulus from the fiscal side of things. So it's two heads of the animal pulling against each other. And that just shows you that's a perfect example of political mismanagement of an economy that most politicians do, unfortunately.
Well, no, actually, Trust is a supply sider, and the supply siders like Steve Moore and others are very much in favor of what she is doing, tax cuts in particular. But as you know, the biggest weakness of the supply siders is they don't do anything on the spending side. They never cut back on spending. So that's the irresponsible part of it. I like the tax cuts, certainly.
Yeah, I like that too, but but unfortunately though, it's the spending part that's causing the bond yields to surge, and that's why the BOA had to step in, like you said, Brian. It's a crazy situation there.
By the way, I want to mention one other thing about inflation right at the beginning. You have to remember 70 million Americans on Social Security, and I'm one of them. And we're going to get an 8% increase in Social Security payments starting in January. If that's not inflationary, that could continue this inflation for some time. And it's not just Social Security, it's union workers. They're all demanding higher wages. The minimum wage is being expanded in more and more states, and they're indexed to inflation. So we're not going to get back to that 2% target rate. I think they'll be lucky to get back down to 4%.
John, did you want to jump in? I seen a little bit of body language there.
Oh, no, yeah, and I know the circumstances are a bit different, but you can have fiscal expansion with tax cuts while at the same time raising interest rates. We did it back in the early 80s, and we were able to overcome. And then, right, we spent everything, but we were able to gin up enough economic activity from a period of slow economic times where we brought a bunch of investment in the U.S. And the UK, it's not the U.S. obviously, but as I said, I like the idea that they're doing. They just had really fumbling, poor execution of it.
All right, well, before we get into some of the other factors, I'm going to take one of the questions. We got one from Mohammed here, and this is the $1 million question here. The question is how to position ourselves in this hurricane. So I know we're going to be talking all day about this, but but maybe everybody give a quick elevator speech on what do you do now? That's the $1 million question. What is an investor to do right now?
Well, there's you have to look at the sectors that are working in this type of backdrop here, and certainly we look what's happening in Europe with the energy crisis here. Liquefied natural gas and the blowing up of the Nord Stream pipeline. That's a big deal, and that is offline now for good. And so you've got to get LNG over to Europe, and Asia as well has got big demand for LNG. So that's a mega theme. Look at the mega themes and try to focus on the 1 or 2 or 3 stocks in there that lead those particular sectors that are going to have institutional fund flows, because you still want to follow the money in any of these sectors. Electric vehicles, mega theme. Lithium, Elon Musk. If you're in the lithium business, that's a license to print money. There's 2 or 3 or 4 names in that sector which are held up very well against a market that's down 25% year to date. Agriculture, we've got a fertilizer crisis over in Europe, and food crisis around the world. There's there's a seed and fertilizer and ag stocks that are done very well and are just barely off their highs. Healthcare, they've got a couple things in there which are going to be, superstar blockbuster drugs like what Eli Lilly is trying to bring here for, Alzheimer's and obesity. So there's another mega theme. So stick with the mega themes here, and tech is going to find its own bottom in here somewhere. But don't with the tide's out, don't fight the tide. Just stick with what's working in an inflationary environment until you see the whites of the inflation start to actually peak and where the Fed does look like they're front end loading this thing heavily, and who knows where, the bond swaps market is saying that inflation is going to be considerably lower a year from now, but that's, long term in this market feels like next week, for a lot of people. And so with that mentality, people are, they want to try to keep buying these dips, and then they get, head fake rally like yesterday, and then you get clobbered again today. So it's important to stay with those themes where the inflationary pressures aren't headwinds, but they're tailwinds.
I think that what you just mentioned, Brian, about the time horizon is a key component of Mohammed's question. So it depends on your time horizon. If you have a long time horizon right now, does appear to be a good time to get into the market. If you have a long time horizon. If your time horizon is just a few years, then maybe it's not such a good time. But during periods like this, you have to be able to make money short term, and you have to be very nimble. Or if you're following a trend following type of plan, like the way we do in our successful investing service, you've been in cash since January 21st. So you've sidestepped all of this market downturn. So you got plenty of cash right now, just a matter of time before we can start putting it back into the market. And that's for your long-term money. Now, short-term, you got to be nimble. You got to be willing to go short. You got to be willing to look at this market and say, I think the next couple of weeks, couple of months are going to be down. So best way to do that is through put options. And we'll be talking about that later in my presentation, how to do just that. But I think just have to be, first of all, be calm, because this, just like the hurricane Mark was just in, it too shall pass. So stay calm first and foremost, and then start making your moves judiciously.
The hurricane passes, but you always got to watch for that second eye wall to hit you. And that's, afraid we're not there yet. And in a true bear market, everything is ultimately pulled down. There are ultimately no safe havens. For now, I agree there are areas that are holding up, and you can play them shorter term. We're at the June lows right now. The market is fumbling around, trying to make a stand there and produce some sort of bounce. But we still have the Fed has, I think we all have talked, pretty much concur, a long way to go still. And the Fed is, I said way back in the fall last year, it will be the Fed, and it will do what it does, and that will cause a recession. And that's what it's doing. And it's not done, because if it's serious about fighting inflation, as Mark was saying, it has a long way to go. And I think this is just a way station in the market as it heads lower. So while we can take some refuge, and it's always a good idea to start picking up on the drops for the longer term investment, I do think we have a significant downside ahead of us. And if we realize that and just accept that, and that'll get us from jumping in too early. We can nibble. You can nibble at good areas at times. And then, if it goes down, you nibble some more. And that's for the longer term, that you kind of look at these kinds of drawdowns as we're seeing now. Otherwise, I'm a short-term trader too. So I do a lot of short-term stuff, and that's what I'm looking at. And I see more downside, but we're going to have some pretty good bounces along the way, as you do in every bear market.
Yeah, we've done pretty well with some flexible mutual funds that, in addition to buying whatever they want, they can sell short. And they have been selling short stocks and some bonds over this period. So they've done well. Also, if you want to be in stocks, you can look at infrastructure stocks. These tend to have reliable demand, and they're price contracts usually have inflation protection embedded in them. So they've held up better than the overall market, and they'll also be generating some income for you while you wait for the economy and the markets to turn around. So those are two areas that have been working well, and I think we'll continue to hold them for a while.
Yeah, and from my perspective, I'm actually quite impressed lately with the stock index annuities. I know most people don't look at those, but my wife was in it for a number of years and she finds it very useful. For those of you who are unfamiliar with stock index annuities, these are insurance products put out by insurance companies, and most of them are lousy and not good deals. But lately, they've been offering super deals where you can get in, where you can get 100% increase in the stock indexes if the stock goes up. And if the stock goes down, you don't lose any money at all. There's no losses. So this is the deals are much better now. I've been recommending David T. Phillips and Company in Arizona, if anybody's interested in getting involved in those products. No downside risk, and the upside now is 100% on some of the stock index annuities. So if John is right that this market has further weakness to go, a lot of people just can't, as some of the people have said, a lot of people in retirement age, they really don't feel comfortable losing 50% of their portfolio of their retirement that's in the market, dropping 50%. Yeah, it's always returned. It's always returned in the past. But at this stage of your life, maybe you want something very conservative. And these insurance companies are rated highly by AM Best and Company. And so I think that's an alternative that people ought to take a look at. So we've recommended that in our newsletter and a number of times, as well as a well-diversified portfolio. But even with a well-diversified portfolio, some stocks, some down, but overall we're down over 10% in this market. Now the market's down 20 to 30%. So we've done better than the market, but we're still down. And and I think it will recover, but who knows? I mean, if we continue to, speaking politically, if we get the Biden administration and their further agenda of higher taxes, higher regulation, more inflation, big spending policies, I mean, I think the market is going to be in a stagnating period of time for some time. So maybe these stock index annuities would be a way to go for some people.
Yeah, Dave Phillips is a estate planning specialist, and both Bob and his Retirement Watch newsletter, as well as Mark, both recommend him. I've known Dave for a long time. He's great, but estate planning specialist, if you want to check that out. Mention when you call them and say Eagles sent them your way, and tell them Roger says hello. We've got about 5 minutes left of this panel. Let's talk. We talked about Europe. But let's talk about China's recession. And what's happening in China? How is that affecting the world and the supply chains? And what do we need to worry about that? And is there any bright spots at all there?
Well, let me jump in on that because I just got back from Asia. I was a speaker at the World Knowledge Forum, which is Asia's version of the Davos meeting. And they had a lot of experts there. I mean, a lot of Koreans, of course, because that's where it was based in Seoul, Korea. But there's a lot of discussion on China, how, everyone was wearing masks. And everyone was in that lockdown mode. I mean, it was really, China is still, they've opened up a little bit, but the fact is that the Tesla was shut down for 3 weeks, couldn't produce any automobiles at all. There are all kinds of problems here, and their economic growth rate is slowing to a pretty low level. China's in a lot of trouble, and I think that's one reason we have Europe in recession. We've got Asia, China in recession, and the U.S. is next. So I don't think much positive. Look at what Russia's doing in the Ukraine. I mean, that's very disturbing, and China supporting Russia. I mean, and threatening Taiwan. There's a lot of negatives out there right now that I think should concern us.
Yeah, I agree with that. And also, I mean, think about this. We were very perturbed here in the U.S. about the lockdowns that happened here. But consider that just recently, China completely locked down a city called Chengdu. 21 million people basically shut in their house for a couple of weeks straight. Now, that is a result of what's called the zero COVID policy in China, which is a disaster for their economy. But the problem also is they don't have they have a horrible vaccine there. They don't use like the Pfizer, Moderna, things like that. They don't use that. They have this vaccine that basically doesn't even work. So they're trying to actually like manage the pandemic still because they never were able to manage it from the first place. But think about having a city of 21 million people just shut down. Think of, LA or something like that, just shut down for 2 weeks. And then you get a sense of the economic pain that would happen from those kind of.
There's a couple other outliers too. You've got, the unemployment rate for Chinese youth is over 20% as of July. You got 40% drop in new home sales year over year. And the one that you can't fix is the low level of the water line in the Yangtze River, where 45% of all Chinese output has to travel by ship. The Rhine is also at record lows. So you're having to train and truck all this, your goods around the river. And it really slows things down and makes the supply chain issues just exacerbate. So these are natural Mother Nature issues that, just cannot overwhelmed with all the spending in the world. So,
hey, Bryan, we have plenty of water in Florida. If you water in Florida,
You can't build a pipeline anywhere.
That's
just go straight down. We'll hit China.
That's a whole nother issue. And
let's
I know,
export a hurricane to China.
we create a river right through Florida, right?
Right, yeah. Well, on that note, I'm trying to keep us on track. We got a long day today, and we're right at the end of this session. So I want to thank our panelists for being on the panel. A great way to kick off this wonderful day today. We're going to take just a 5-minute break, and then John Johnson is going to come back and with his presentation. I want to remind everybody that to subscribe to our YouTube channel, just right below this video, there's a little subscribe button there. Make sure you subscribe to that and keep up to date on all the great free content that we have on our channel. And like I said, at least one new video every week, and we've got a lot of new things planned down the pike to be adding to this. So we're very excited about this new venture we have, and we really believe in education. That's why we're doing this today. We want you to be an educated investor, and that is really what Eagle is all about, because we know if you're well educated, you're going to do better in the market. You're going to follow our subscriptions, and that's why we're here today. So we're thrilled to have this event today. We're thrilled that you're with us, and we're going to take just a short about 4-minute break now, and we'll be right back on with John in just a couple of minutes. Thanks.
Thank you.
You guys.
Well, welcome back, everybody. That was a great way to kick off that panel presentation. I hope you enjoyed it as much as I did. That was a lot of fun. I learned a lot, I know. I'm sure you did too. Now we're going to our first solo presentation. We got John Johnson from Investment House. And as you can see on the screen, his presentation is Making a Good Trade, a Great Trade. So John, looking forward to your presentation. Take it away.
All right. Well, we've all been in the situation where we make money on a trade and then it goes up higher and higher, it goes down more and more. And we thought, well, I left something on the table, and you kind of scratch your head and wonder what's going on. Well, we're going to learn how assets move today in order to maximize our gains. I'm John Johnson. I've been at this for over 20 years. My philosophy is just take what the market gives you. So I'm agnostic. It can go up, it can go down. I don't really care, because the goal is to make money and to be able to do what you want to do when you want to do it. Now, I'm going to ask a couple of questions. I don't mean we don't have any formal response on this. You can put something in the comments if you want to, but think about what kind of trader you are. Are you a value trader? Are you a technical trader? Do you trade fundamentals, momentum? What are you? Because as we go through this, that'll become, you'll start thinking about how that can apply to your trading methods. And also consider this: what is the most difficult aspect of trading, or you can say investing if you're not so much a trader? What's the most difficult aspect to master? And be honest with yourself. It's maybe not what you know, maybe it's inside you, who knows? But think about it. We'll see what we can come up with. Now, what I do is that I trade technicals, asset patterns, trends, key indicators, good fundamentals. That's great if the market is moving up. That all the better. It helps, make a sound trade, trading in good stocks. And for the downside, though, when the time is right, fundamentals don't matter, as we're seeing right now. There's pockets that are doing well in this market that's turned into a bear market. But ultimately, if it's a true bear market, are going to get torn down as well. So fundamentals may not help you. It won't help you in that situation. Now, here, what I like to do is look at patterns first. A lot of people look at trends. I look at patterns. And if I go through some of this quickly, just hit us with a question. I want to get through this basic stuff so I can really get to the meat of what I'm talking about. But I want you to, this sets it all up well for you. But what to do is we identify the patterns of whether they're bullish or bearish of what's going on. Because if we do that, we can get a little bit of an edge. Is anything developing that's contrary to a trend? We can see the pattern, and then we can take a look at where it is in the market. Of course, doing that is work, and you have to look at a lot of different sectors, a lot of different asset classes to define that. But it pays really big because it does give you an edge and a trend shift. And as we know of late, trend shifts are important after we've gone through so many years of almost perpetual upside. It's been really, it's been trying to see the change in the market and then shift to the downside. So you can get an edge turning the corner down or turning the corner up, as I like to call it. And you can do that by looking at the patterns before the trend changes. If you just look at the trends, you may not see those until it's too late. Here's one that I was looking at, Omeros Corporation. I saw it formed an inverted head and shoulders. Well, it just turns out that the trend was still way down at this point. You can see the white line I put in, where it shows you where the trend is, and it was still down. And if you waited for a trend break, well, you would have waited a long time, but you just still got to play. But I like to play off of these lows before the break, before it actually makes the move, if I can, particularly on an inverted head and shoulders. And you can see we were able to turn a pretty good trade. That's just a stock trade right here. There's no options on it. So it's just a straight stock trade. And just by spotting it on the bottom, when it was turning the corner, we're able to take a good trade and then over a series, make it a great trade. And of course, they don't always continue higher. They do go back down afterwards. But let's talk about how to maximize that trade. We all want to get the most out of the best setups that we can. And the way we do that is to let our winners run. And that was a phrase that my mentors used to tell me, and it was just confounding. Let your trades run. Sounds great. It's so true. That's how you get the most out of a trade, is letting it run as far as it will, up or down. But as they just say that, how do you follow it? I did a lot of things. I would let the trade run. They said, you got to let that trade run. So I'd let it run. and I would have a 50% gain in some options turn into zero because I let the trade run. And it had to be a better way than just, there was something I was missing. So you had to figure something out that would work for me. So what you need, and this is what I'm talking about when you consider what kind of trader you are and what the most difficult aspect for trading is. For me, it was controlling the emotions, because when your money is on the line, there's a fog created. It gets in the heat of battle, poor decisions are made. You'll see coaches have a list of plays that they want to run in certain situations, and they will refer to that list. And I've talked to some in the past. I said, when I deviate from that is when I usually run into trouble, because I'm not playing the percentages. I'm not playing the odds. So if you have a winning trade and you need to let it work, but you're fearing losing the game because especially in a market as we have now, it can turn on you rapidly. So what happens? You get anxious, you start to second guess yourself. And at the first sign of some slowing, you relieve that anxiety so you can sleep at night by selling and taking the gain, which is not a bad thing. I mean, you book some gain, that's a good thing. But then it pulls back a little bit, and then it takes off, or it bounces and then rolls back over. And you're like, I know I'm missing something. So we have to figure out a way to avoid premature bailing. And, we all should have a trading plan, an entry, stop, initial target. That helps a lot following that. But it's an initial target. I'm going to get back to that. Doesn't matter what kind of asset you're looking at. We need to learn how assets move, because they all move the same, whether it's crypto, stocks, bonds, rice, tulips, those NFTs, doesn't really matter, because they all have humans involved in them, or machines that are programmed by humans. And through the years, through the centuries, they've moved the same way, and they're still doing it today. It's uncanny. So what do we need to do? We're going to maximize our trade. We found a good trade. We know what we're in, but we want to make the most out of it. We want to squeeze it for what we can without adding extra risk to the trade. So we're going to learn the life cycles. We're going to learn upside and downside. They move in regular patterns. We're going to use technical levels to fine tune our understanding of the position, Fibonacci levels, support and resistance, gaps, many things out there we can use. And then we're going to institute a very important part of this. We can understand everything else, but we still, when our money is on the line, we don't have that emotional comfort. It's still there. We're still fear of losing. And for me, the big change was starting to take partial profits. You get to a logical point, the first run, and you take a gain at that time. But not only once, you're going to use your knowledge to take gains at optimal times throughout the movement of the stock or the asset that you're engaged with. So we're going to use the combination of understanding the life cycle. We're going to use technical indications as an overlay to that to give us an idea of when would be maybe a good time to take gains. And then we're going to use partial profits to take some of those gains and thus relieve the pressure of, I just got to sell it to get it over with. I cannot lose this nickel, because believe me, I had this thing. I was a perfectionist. And if I started to lose a nickel, a dime, or whatever on a trade, I started to get all amped up and worry about it. And what happens? You make the poorest decision at the poorest time when that happens. So we want to have our knowledge work for us and lock in gains when it's technically logical, and stop guessing when a top or bottom is in. Well, we can have a pretty good idea, but a stock, any asset, as we've seen with crypto, it can run farther than you would rationally think it could run. You think it's got to be a bottom. No, it doesn't, because it's the market and it's going to do what it's going to do. So when we add all these together, we're not going to hit the perfect top, the perfect bottom every time, but we're going to tilt that scale. We're going to put those cards in our favor so we can maximize the gain for that trade. Roger mentioned this earlier. you know more, you learn more, your confidence goes up. That helps you with your emotional control. And when you understand your system and why you're doing it and why assets move the way they do, then you start pulling that control to you. You start defeating that little demon inside of you that was saying sell all the time. So let's learn that life cycle. What are we going to do here? Well, first of all, we have the overall market structure. It's either cycling, it's up, or it's going down, or it's no trend, it's in transition. We've seen that. Is there a preference in the equities market that applies more than the other markets? Was there a favored sectors, growth versus defensive? If there's strong trends, yeah, we can string moves together. If there's no trend or transmission or transition point, well, the moves are going to be shorter. I mean, we had the NASDAQ go into the transition in late 2021, and it topped physically, visibly, you could see it, and then it broke to the downside. We have to look overall. I said, right now, what are we in? Are we in transition anymore? No, not really. We've transitioned at this point, and now it's a matter of bounces inside a downtrending market. But we need to understand where the market is overall so we can see if we're lining up with the overall move or you're going to tilt at some windmills. And then you look at the asset itself. What do? Well, they build a pattern. They'll break up from the pattern or they'll break down from the pattern, depending on what it is. They'll have a move after the breakout, or they'll fail in their breakout. And even a failure in a breakout or a breakdown can yield us good plays, good patterns to play. And I'll talk about that a little bit when we look at one of these, because the money talks, and as they break up or break down, they're telling us, and we want to take note of what the asset's telling us. So we can have bases and patterns and trading ranges. We can have upside bases where they accumulate. We can have downside where they distribute. And there's several examples of that. There's a trading range in ServiceNow. There's a cup with handle in Apache and an oil stock. There's a double bottom and a utility here at EQT. And these are things that I cover in my services. We're not teaching this today. I'm just showing you what the process is. Here's NVIDIA at double topped, had a pair of tops right here, and then it started the process of rotating lower. So we recognize the head and shoulders, the double top, and what have you. So that's what I was talking about earlier. We recognize those patterns, then we see if they're in conjunction with the trend or not. And then mainly, are they going to make us money or not? So let's look at this cycle a little bit. We have the breakouts and the breakdowns. That's when the stock's going to make its move from one of those patterns or trading range. You'll get an initial break. Often you'll get a test where it comes back or moves back up and touches the key level it broke through. And then it's going to succeed and continue on with the break, or it's going to fail. And as I said earlier, a failed break can give you a very good chance the other way, because what happens is you get the buyers, in this case, pushing a stock up, but then it reverses. It was unable to hold a break, and then it dropped. Or if you look at Alphabet, it was in a trading range. It did 4 rotations. It tried to break out. It failed. And then it head the other way. So just because a pattern fails doesn't mean it's going to be a failure as a possible trade, because why did it fail? The sellers took over in this case. The breakout failed and they shoved it not only down back into the range, but through the bottom of the range. So that can be a powerful indication as strong as a breakout indication. Now, let's say your breakout succeeds, or it's one that reverses and you have a good setup to play it to the downside. This is where a good trade becomes a great trade, because you get a breakout and you can make some pretty quick money on it, and you can pocket that and move on and look for the next breakout. The problem is stocks tend to do this all at once in many cases. And so they break out. And if you go out of one, there's nothing else you can really buy because they're all out of buy position at that point. But in any event, what we have after we get the break is we want to be able to stay in the play and let a good play work for us. And then if we want to augment that trade later, add to a winner if it's really working well. We'll get a move to the 10 or 20 day moving averages, the exponential moving averages typically. They'll act as support on a stock that's rallying or resistance on a stock that's selling. You'll get 4 to 6 moves and sessions of movement, and then you're going to get a test. And that's going to come back and test the 10 or 20-day EMA. And that's usually 3 to 4 sessions. One of my favorites is what I call a 1, 2, 3 test. It's where you get a move up and then you have a 1, 2, 3 down to the 10 or 20-day moving average, or you get a move down and it makes a 1, 2, 3 move up. And then if everything remains status quo, if the market still looks the same, if there's no different news on the asset you're playing, well, then typically the move repeats. So if we look back at that NVIDIA chart where we had the double top, sold down to the bottom of its range, it tried to break higher, it failed. And then what happened? It sold 1, 2, 3, 4, 5, 6, transition day, 1, 2, 3, up to this magenta line, which is the 10-day moving average. And from there, it gapped back down, 1, 2, 3, then it went, let's call it 3.5 to the downside. And then it reversed and moved up to the 10-day moving average with the doji. So what we're seeing is you get this movement, the break, in this case, the selling, and then the test of the 10-day. This one up here, the Sienna line, that's the 20-day. Stocks will use either one of these on their test if the move is going to sustain itself. If it's not, it's going to break down at that point, and maybe NVIDIA would just move back up, and then we'd have to see what it did here. But when they get in this pattern, that is a strong break, and there's a good, strong trend in place.
Let me ask a quick question,
Yes, sir.
John. So on the first one where it says 1, 2, 3, and it crossed the 10-day moving average, but then it broke down. When, so after it crossed back down, you pretty much knew it was probably going to go down. But at what point would you say it's going to continue to go up?
If we're right at this spot right here on this first test.
Yep. Mm-hmm. Yeah.
Yeah. Well, if at that point, it's going to show us at this point whether or not this is going to hold. And if it's going to break on through here, well, this is going to be the first, this will be the critical test after the initial break. This is the one where it's going to show us whether it's going to move into this continuing move. If it does not, if it breaks on through here, then no, it's not going to do that. And that's when then your character has changed at that point. But what I'm showing you here is typically when you get some pattern develop and you get this break, then you're going to typically have these kinds of rotations if we get a trend moving. And in a trending market that's either trending to the upside or downside, on an upside, this is going to be more of the case. Transitional markets, and we'll cover this in a little bit, tend to be choppier, shorter, and this is not going to be, you don't want to let these positions run that far. But a lot of it depends on the overall market that we're talking about. Is it trending? Is it trendless? Is it trending up or trending down? And if we're playing with and trades in the trend of the market, then we're going to get this action more. I'm glad that was a good question. I wanted to clear that up more, because typically when you have these kind of trends, you want to be able, this is when you have a trend, these work with the trend overall. And if you're in a transitional market, then you have much more chop. And if you're going to get, well, I'm about to go on to it, and let's good place to do that. If this succeeds, and if you get past that first level, you're going to get 4 to 5 rotations off of the 10 and 20-day moving averages. Now, after 4 or 5 tests, it kind of wears itself out. In any kind of cycle, 4 to 5 is usually what you get, whether it's a trading range or a breakout move. You're going to get 4 to 5 cycles, and then it's got to take a breather. It'll either bounce higher or it'll bounce lower, and it's usually to the 50-day EMA in a good, solid trending stock in a trending market. And then again, if the status quo remains, if like when we were trending upside for a dozen years, well, then it's going to restart the 10 and 20-day moving average cycle. And then after that, 2 to 4 rotations of that kind of all the way down, 4 or 5 runs to the 50. You're going to have to, it runs out of gas. It has to rebase and start the process over again. So if we look at some examples, here we have Newmont Corporation, a miner. And late in the year, it was basing while a lot of tech stocks were topping out. And it formed this cup with handle. You had a breakout. You had the breakout test. And then you started from there. It came back to test the breakout. It started its run where it's making its rotations. And you're getting your 4 to 5. This one, I believe, got 6 in it overall. But you see that it'll make the run and it'll make a good move, and then it'll show you some type of topping sign. Like here it gapped and started to reverse. Here it was a tombstone doji. Here was a gap reversal, gap reversal. You get 4 to 6 runs to the upside, and then you start looking for it to start to stagger. It just can't keep the momentum up for that long. And then it starts to top. That's okay. That's just a normal move. You don't panic about it. It's just what you're looking for. It's what you want to happen. Because there was a book written at the turn of the century, and I'm talking 19th century, or I guess 20, in the 1900s. I put it in the 20th. It was Charles Darvis, and he noticed this when his stock trading. He kind of came up with it on his own, that this is very healthy action, and you don't have a problem with any stock you hold while it's showing this action. So we have these kind of breaks, and then we get the moves higher. And we're going to see here it happen. There was remember I said as long as the status quo remains the same, we had a shift in status quo in the market because the energy stocks and the commodity steel stocks and metals topped out, and then they went through a transition. They broke support and turned the other way. And you can see it moved through the 200-day moving average and just turned it completely over. But you could also see this pattern was forming at this point. But you got your 5 runs, and it was due for a test. It made the test, but it could never recover that 50-day. It went through it, and this should have held if it was going to keep moving, but it didn't. It went through it, and it tried to recover and failed. And that's when it rolled over and went the other way. That was a change in character in this. That's why the watching after these runs, how they test that next level of support, usually the 50-day moving average, how they hold there will determine if it's going to continue the move or if it's run out of gas, which is what happened here. When it broke it, that was a change of character, and that trade was over until it could show otherwise.
And it's the 4 to 6, as you said. It was 5 on the way up, it went down, and there was 5 more, and every time it's hitting that one level, it was doing that pattern over and over again. It's pretty amazing.
Market loves symmetry. Nature loves symmetry. And I sound like some tree hugger or something, but it's just one of those things where over the years it's like it works that way, and it works for the indices too. Here we're looking at NASDAQ 100, and this is recent time when it bottomed in June, and it made full rotations and went up for this fifth one. It couldn't do anything, and it came on down, and well, it couldn't continue. And what happened? It rolled right back over, and right now we're right back down at these June lows. Whoops, sorry about that. I messed up. We're right down at the June lows right now. And the market's trying to make a decision as to whether or not it's going to bounce, which it probably should for a while. But, probably should is something the market doesn't really pay attention to. But technically, we should get a bounce here. It's fighting hard to do so. And we'll see if that plays out. And then once that's done, well, we'll know more about what the market's going to do from here. Some people will view this June low as a potential bottom in the market. If the market does bounce here, I guarantee you there will be people who will be calling this the bottom of the market. And the probability is they will be wrong, but this might be a pretty good bounce here to the upside. because what should it do? Well, it should bounce up to those 50-day moving averages, and that would instill some confidence. We've had our rotations to the downside. It should bounce up there, and that'll get people excited again, because what happened here? It broke through the 50 days and it broke that trend down, and that got people very ginned up until the CPI hit, and that was the right here at the 1. That was the sharp dose of reality, and things came tumbling back down after that. So we're at another time, Roger, that we're on a conference and we're in a very critical point. I think we were at one of these in Vegas as well. So yes,
We were.
the critical point, and it was a very good teaching time at that point for sure. This is a what I like to call the lick log right now. Okay. You also have to just kind of know your assets as well, because some stocks don't necessarily use the 20-day to come close, like ConocoPhillips. It likes to use near the 50-day. It's like kind of, in between a 45-ish. So you just understand your stock a little bit, and you look at the back history of it and how it moves. And so when it breaks out, you can anticipate, hey, maybe it's going to use the 50-day, whereas most of your stocks are going to use the 10 and 20 in these kind of moves. This is a really good one here, though. This was a nice low volume right before the breakout. A lot of nice stuff there. Okay, now we need also just not pull these out of thin air as to like, okay, I'm going to take a gain here. Oh, I'm going to take a gain here. You can look at the chart and you go, yeah, well, that was easy because you're looking at a chart that's already happened. Well, it just so happens that these are stocks that we traded, and I'll show you some more of these soon with where we entered and exited. But we picked the targets with a method. We use those other influences on the trade that I talked about earlier, the Fibonacci extensions, the 127, the 150, 161, the 200. Those are important extension levels that rallying stocks tend to move to. We look at prior gaps. Is this coming back to fill a gap, or are there prior consolidation levels that could stop it as it bumps into it, or it bounce it as it comes down onto it? And then we also look at significant moving averages. If the stock is trying to reverse, or if an asset's trying to move through one of the old trend and break through one of these moving averages, they're going to act as some resistance initially, whether it ends up breaking through ultimately or not. They can result in pauses and consolidations, and there's your potential targets to take partial profits. Now, here's a Halliburton trade, and I'll go through this a little bit because it puts together many things. But we had the pattern, we had the breakout out of the triangle, and then you see these orange lines here. We see the rally, nice rally upside. Okay, what do these orange lines represent? Well, here's the first move, okay? Right here, the breakout from that low to there. Well, we took a Fibonacci extension from there. This is the 128. This is the 150. This is the 161. That's the 200 right there. As you can see, they roughly coincide with tops on these moves. It's not 100%, but they give you an idea of where you want to take gains. And then you use the other factors, such as big old tombstone doji there. And you can see that I see them developing during the day. So I know, well, time to take some gain here. And you'll see gap reversals as well. It just tells you that that move is running out of gas, so to speak. But you also, it's not just like, I think this is a good time right here. No, there's a method to it using these other technical indications. And you can see that while it's not a blow for blow, move for move correlation, it's very close.
Just to let you know, we got about 10 minutes, John.
Okay, sorry about that. Okay. So we want to ID the asset where it's in its cycle. We want to make sure it's saying something to us that we can trade it, that it's a good trade. Now, we can have a trading range with a failed breakout, as I saw with Alphabet earlier, and you can get a nice move. That's okay. That works as well. You don't want to limit yourself into just locking upside or downside. Let the indications show you. So is there a breakout approaching? Yeah, here we got a good breakout, Lulu, but ultimately the breakout failed on this. So we let it make the break. We let it show us it's going to move. And once it starts that test and can pass that test, we start our play. So we need to ID where the asset is in its cycle, because as we're showing, you could be running 1, 2, 3, 4, 5 rotations. So you want to know where you are so you don't move in too late. Or if you do, you know where you are. We trade on Nike, we did this. We were able to trade to the downside. And we knew we were in a transitioning market here. So we knew we were also in the third rotation. So we took gain as it came down. We got, okay, this is rotation number 4 we took advantage of. We didn't know if we get a number 5. Turned out we did. It did everything right. It went down to 5. It moved up to the 50-day, and then it started down again. But as a precaution, we took 2 partial profit gains on there, and we took almost doubled it the second gain just by letting that run and using the moves as our guide, using the market indicators as our guide. And we had a low right over here. That was why we were taking profit there. It doesn't show up here. Sorry about that. Okay, so you've done everything right. And so you're going to change your methodology and let profits run, or you're going to let emotions take over. No, now we can start to have our targets. We can take at that first target, we're going to have more than one, but you have that initial target. You're going to sell a half or a third, whatever you're comfortable with at that time. You let the test occur. If all's normal, you let the trade continue. You continue to do this. On the second one, you take half of what's left. And after that, you pretty much want to let the position work. Let it go those 4 to 5 rotations if you can. And then if it gets to a point where you see signs of reversal or you're uncomfortable, take the gain. So we can get all kinds of, like we've been talking about, gap reversals, doji, spikes in volumes. You're using those in the Fibonacci and other areas and where you are in the trade to make it a decision, so you aren't making an emotional decision about the top or the bottom. You take those partial profits and it relieves that pressure on you. So here's some trades that we have. AMD, you can see we entered, and then we took profit number 1 at the top, prior top of the base. That was our initial target. Then we let it run. We got a doji here, and we took profit 2. Let it test, let it rally. We got to close off the high, gap reversal, and it started to come down. We took target 3. We could have let it run further for sure, but when we do, sometimes we do that when we have a huge gain, and a lot of it depends on our options. We were running out of time on these options because the earnings announcement was not working with us on this one. So we had to go ahead and take those gains. AMD,
and why not take a 438% gain?
Well, yeah, I mean, yeah, it's true. That's true. And if we waited much longer with the options, they start to melt like an ice cube. And so you might see, even if it keeps going up, you can see 400 go down to 300 or 200. So take it. And here we got AMD. It broke out of a little triangle here. And this was the entry point, matched the prior high, took gain there. Doji, oh no, this same one, and it rolled over. I'm sorry. I'm sitting here talking about the same thing. And I just wanted to show that it turned out this rolled over. So, you know, if you have reason to take it, whether the options or a large gain with options expiring, there are reasons to take it. Here's Silicon Labs. It made a rotation, a trading range. It broke down, it tested, and then it started its move to the downside. Now, made this huge outlying gap, and that made just a great point to enter because it gapped lower from there, and then it did its 5 rotation down. This one, I missed the first one here, but this one was just too much to resist. And with that gap, and we ended up making a really nice trade out of this. And we turned, you know, the first target was great at 90%, and then it went up almost to 200 after that. And we could have taken more because it came up to the 50-day and then continued down. So we just transition, we get choppier markets, and if it's like that, if you have a stock that's being choppy, has been acting choppy, you can really move it down to 2 rotations is what I do. I bank the half on the first and then all of it on the second. Here we did this with NVIDIA when it broke down, and we had reasons. Here was a gap. It filled the gap. So we took some. The next day it sold off hard, but started to reverse. And this was when the market was a little bit transitional. So we were a little bit gun shy of staying in the downside very long. Turns out it reversed and it did move back up. But we took half, and it was logical reasons. Gap fill, reversal at the 200-day moving average after a big reach lower. People were still buying on the dips then. Trex, similar, it's more recent. Gap, and it made some nice moves down. Turns out we could have held it longer than we did, but we did not because we just weren't trusting it. The housing market was showing too much resilience at that time for some unknown reason. And then you can double up as a
3 more minutes.
okay. Well, point is we can double up more, and while we have one trade going, we can get out early here with a 234% gain. But we can also, using our Fibonacci there, we did that. We can also add in these other levels here. And we came in and entered again on the dip and used the same routine to let the stock run higher and make money on it, doubling up on the trade. So we're going to do what we can to identify what the market's doing. We don't care if it's going up and down. We're going to take what it gives. And we still think we've got some downside here because this is the trend line out of March 2009 and early 2010. And the Qs could still drop to 250. And so, hey, could still drop lower. And so, you know, we want to take advantage of that trend while it's there. We give you in the daily commentary daily about what's going on in the market. We give you continuing play tables. We give you alerts that tell you when to enter our plays, text and emails. We have a great website that you can get to all the information from. And as things happen, we'll give you alerts. We'll give you new trades on the weekend. We'll update new trades as the market moves during the week to keep you on top of the best plays. We've got a great offer right now. $3,995 a year usually, but you can get 90 days for just $90. That's a pretty incredible rate. I think there's going to be a link that they can sign up there.
Yeah, there's a link in the chat box right now, and there's also above the chat box there, the link is also embedded there. And so, yeah, it's obviously a great offer. And there's a quarterly charge after that, but it's at a highly discounted rate as well. But we just really, for today's event, we wanted to give an absolute great deal. We know everybody else is raising their prices and things are tough out there. And you can tell from John, and here's the thing that John didn't say, is you can just take the trades and let him do all that hard work. But at the same time, he really educates you on what's going on. He has videos throughout the week. The commentary in the morning and the night is just outstanding. And, so you can again, I'm going to probably be saying this all day, education. and John educates you and you understand what's happening and why. And I just, we just feel that's very, very important. So again, click that button now to get the special offer for 90 days for only $90. And we got like about 1 minute left. I don't know if you have any final words.
It's just, I hope everyone will take advantage of this because I do this because I love teaching people about this. And, there's been a lot of talk lately about, are we in a bear market or not? And, Roger was there back when we said last year that there was going to be a bear market in Q1 of this year. And it wasn't any magic. It's just that we've been there, done it. And we apply history to what the market is showing us. And so I'm a big history buff, economic history, and we do the same things over and over again. And that's why we pick up on things such as how stocks and assets move. And we want to teach you that. And then, like Roger said, if you just want to look at it and go, hey, that's cool, and then make the trades, well, I got no problem with that because I'm making them with you, and we'll all make some great money together. So I hope to see you there. And, we're going to do some more seminars and we can make some more outlandish predictions, Roger, that didn't turn that weren't so outlandish after all.
Exactly. I was actually just talking to somebody else the other day that you said at one point the market's going to go down, 45%, especially the NASDAQ. And, we're pretty close to you being right on exactly on what that was going to be. So, but anyway, click that link now to sign up for Investment House Daily at this terrific offer. Thank you, John, for joining us today. And up next will be Jim Woods, and we'll take about a 5-minute break. He's going to start at the bottom of the hour. And again, reminder, everybody, sign up for Investment House Daily and also hit that subscribe button below the video to subscribe to our YouTube channel. I'll see you back here in just a couple minutes. Hello, everyone. We welcome back, and we have Jim Woods up next, and his boy, I'm already not being able to talk after a couple hours here.
The day is
let me
long,
try that
Roger.
again.
You got to pace yourself now.
let me try that again. So his presentation is "Be Quick or Be Dead: How to Use High Velocity Options to Capture Alpha." So this is we've had some great success in high velocity options, and the way Jim does them, it's very, very interesting, and more importantly, very successful. So Jim, take it away.
Thank you very much, Roger. Thank you, everyone, for coming to visit us here and for our first annual virtual summit. Hopefully, we have more than an annual one, because we all love doing these things, and interaction with subscribers is key. If you have any questions, also, I think there's a chat box there, so feel free to fire away, and we'll try to get into as many as we can at the end. All right, so I'm Jim Woods, and this presentation is about my service, my trading service, strictly options trading service called High Velocity Options. Okay. Now, today's presentation: Be Quick or Be Dead: How to Use High Velocity Options to Capture Alpha. Now, some of you who know me know that I'm a big music guy. You probably can tell by my office/studio. Particularly I like all kinds of music, but one of the kinds I like is the heavier type of stuff. So Iron Maiden is one of the bands I like a lot. And they have a song called "Be Quick or Be Dead." And ironically, some of their messaging around in the video and this picture right here, this is actually one of the album images. You can see it has stuff like banks take a $500 million hit, Ivan Boesky pro, markets face 2 billion losses. The song is sort of about being quick and being dead. In financial markets, that's very important, especially right now, because right now we've seen the market down. I think the S&P is down something like 24%, 25% after today, probably. The NASDAQ's down 32%. The NASDAQ 100's down 30%. Apple's down 5% today. I mean, the market is being crushed. You don't need me to tell you that right now. Everyone knows. But in high velocity options, our portfolio year to date is up almost 16%. Now that's up almost 16%, not down. So we're crushing the market. And that is all of the trades, the winners and the losers. So when there's been a few, we've got about a 60% win rate right now in our puts and calls. So we're doing real well. And more importantly, the big gains that you get when you hit the mark right, when you're really good with the high velocity options, are in the several 100% range. I'm going to be showing you some examples of that, exactly how we did it and exactly how we do it in this presentation. So in a market like this, especially, I mean, in a bull market it matters too, but in a market like this, you have to be quick or you're going to be dead. And I know a lot of people out there just hold on in the market. Oh, we're just going to hold on, no problem. You're down 30, 40, 50%. Now, you do not want to be down 34, 50% without having another way of taking advantage of the conditions in the market right now. And right now, you can do that: targeted call options, targeted put options. And the best thing is, too, when you buy puts and calls, you're only spending a little bit of money relative to if you actually bought the whole stock. So I'll go over all that in a moment. So let's get to it. Okay, be quick or be dead: how to use high velocity options. Now, I'm not going to go through this in detail because I know a lot of you already are subscribers to Eagle, probably subscribers to my services as well. But here's just some of the many services that I have with Eagle: options, bullseye stock trader, etc. A couple here to note is the Deep Woods. That's my free letter. So if you haven't got that, definitely check that out. I know you'll enjoy it. It's all kinds of different content. And then also my podcast, Way of the Renaissance Man. I encourage you all to check that out because there's a lot of stuff on investing there, but there's also stuff on lifestyle and enjoyment, the stuff that we like to do when we make a lot of money. So check that out. All right. So what is high velocity options? Okay. Well, in anything in life, in any mission in life, you have to have a mission statement so you know exactly where you're going. Okay. Now, our mission statement in high velocity options, it's a trading service that identifies the fastest moving call and put options that traders can use to earn huge profits in just a few weeks to a few months. Okay. So break that down a little bit. We go long, we make money on the long side, we make money on the short side. This market, it's important to know how to make money on the short side, and that's what we do. And when I say huge profits, I mean big gains. We're trying to hit home runs with high velocity options. We're not trying to hit singles and doubles. We're Aaron Judge in this service. Yeah, we might strike out sometimes, but we're also going to set the record 60, 70 home runs a year. That's what we're going to do. By the way, has he done that yet?
He tied the American League home run title last night.
Oh, okay,
At
good.
61.
So he's at 61 now.
At 61. So,
Okay, that's
so
great.
he's still got a few more to hit the all-time baseball record, but he tied the American League record last
Okay,
night.
yeah. See, I knew Roger would know because Roger is a huge sports guy, and I'm a medium sports guy. The older I get, the more I've been taking it, watching it, and checking it out.
Yeah, you have watched sports a lot more in the last.
Yeah, I've been enjoying it more
last
lately.
several years.
I mean, yeah, exactly. I've
When we
always
first started working together, you were just like nothing.
yeah, yeah. I mean, well, that's because I had my head buried in this, in puts and calls and
Yeah,
chart
exactly.
reading and stuff. But you learn in life to enjoy things out there. So, but anyway, so we want home runs, we want huge profits, and we want them fast. We want them in just a few weeks or just a few months. And actually, by being fast, ironically, you reduce your exposure to the market and you are in and out faster. So you're not leaving it out there to take the hit or to suffer the consequences of when you're wrong. So we'll get into that in a moment. Okay. First thing you need to know is, in addition to my newfound interest in sports, I've always had a long interest in philosophy. I was a philosophy major at UCLA. And one of the things I think that's important to cultivate is a breadth of knowledge around a lot of different things. So the first options trader is a Greek philosopher. Okay? His name was Thales. He's famous for saying things like, the most difficult thing in life is to know yourself. But he's also famous for being basically the first scientist. Okay? Now, in ancient Greece, philosophers, scientists, they were kind of looked down upon by the ruling class because they didn't have much money. It wasn't like a exalted profession, but of course they were really smart. And Thales didn't really like this. He wanted to be, he wanted people to know that philosophers and scientists are really like the smart people in society. So he decided to make a little bit of money on doing this. So he was able to, because he was a man of science, he was able to calculate the weather patterns in ancient Greece. And he figured that this upcoming year would be a good one for the olive harvest in Greece. And so what he did is he said, okay, I think there's going to be a big olive harvest. People are going to need olive presses. So what he went out and did a few months before the rain started, before the harvest came, he went out and bought basically call options, or the right to rent out the olive presses in all of Miletus and all of ancient Greece. So basically he cornered the market on olive press usage. Well, what happened? He was right. It was a great rainy, the season was great. The harvest was huge. And all of these olive growers had to use the olive presses to make the olive oil. Well, Thales had all the rights to the olive presses because he was smart. He knew that he bought call options on those things. So what happened? He decided to rent out the olive presses to the olive growers at a huge premium. Okay. So he bought a small call option on the presses and he sold the option, sold the right to use those presses for big money afterwards. So he proved that if you use your rationality, if you use science, if you use the tools at your disposal, the rational philosophic tools at your disposal, you'll be able to make a lot of money in the markets. And you'll be able to do so especially well if you can predict or be right about future events. And really, when we're talking about puts and calls, we're talking about future events, because unlike a stock or an ETF or a mutual fund, when you're doing options, there's a time element involved, and that's what makes it so profitable. But that's also what makes it so, volatile and potentially like dangerous, as far as if you're wrong, you're going to lose a lot. If you're right, you're going to win big. So the key here is to be right way more than you're wrong. And that way you can be like Thales, prove everyone that you use your reason to make big money in the markets. And that's what we're doing in this service. So Thales is one of my heroes. And if you want more information on this story, if you find it intriguing, one of the videos here at Eagle Investing Network is about that very thing. So I go into much more detail about this there. So check that out when you get a chance as well. And also subscribe to the news channel too. By clicking that button, you'll get a lot of great content. Okay, move on. So how do we do this? We know how Thales did it, but how do we do it? Okay, so for call options, we start by identifying the stocks that have what I call the big 5 major characteristics that need to drive a stock higher. And what are those? Let's go through each one by one. So the first thing is price, and specifically relative price strength, because in life, winning begets winning. Okay. So what we do is I put my kind of Thales hat on, and I start screening out there for the stocks that are outpacing their peers for the past 6 to 12 months. And this is on a relative strength basis. So if the market is down 15, 20, 30%, but this stock is up 15 or 20%, that means it's outperforming the rest. Okay, just like our newsletter. We have a high relative strength rank versus the market because we're far outpacing these things. And we want consistent proven winners here. So we want the winners we want the best of the best. We want, if the stock is in the top 20%, top quintile, let's say, of other stocks, then that's what we're looking at. So we're looking to only to screen out the kind of the donkeys. We only want the thoroughbreds. Okay, that's the first element. The second element is what I call earnings power. Now, to the victors go the earnings spoils, which means when a company is earning a lot of money, they are out there, they're winning, so to speak. Okay, so we screen for stocks that are outpacing their peers, okay, for the past several quarters and the past several years, because we want that consistent. We don't want just 1 or 2 earnings winners winning quarters. We want 1 or 2 recent earnings quarters, and we want a couple of years of earnings growth as well, because that way we can determine the best stocks out there on an earnings per share growth basis. And that is one of the things that really drives stocks up. When serious investors are looking for the best stocks to own, we all look for earnings, because that's what drives a stock higher. The buying, of course, is the number one thing, but then the earnings are what fuel it. That's the fundamental element. So here again, we want a consistent proven winner that's outpacing at least 80% of the market. So we want the top quintile here again. So we're looking for the best performing stocks on a price basis, and the strongest earnings per share growth stocks out there. So right there, we eliminate tons of different stocks that are just undervalued, slow moving, not earning, missing earnings. And in this next quarter or 2, I anticipate a lot of bad earnings. So this is extremely important to find the cream of the crop right now, because the crop is getting worse, but there's still going to be the top stocks out there to choose from. So you want to make sure you know what you're doing and pick the right ones. So earnings power is one of the ways we do that. All right, next one, technical analysis. Okay, the beauty is in the pattern. So once we've screened for the best of breed stocks in terms of the price and the earnings power, we need to check out the technical pattern to determine if now is a good time, or if now is a time to avoid it, because sometimes a stock has good price performance, but it's just way too overextended. Sometimes the earnings are strong, but it just got sold off on some kind of a news or something like that. And these certain circumstances and mean you might not want to go into a stock at that point, even if it has good earnings and good relative strength. So we look at the pattern. So we want the chart here to reflect one of three or so different bullish chart patterns. The number one is the cup with handle, which is a pattern where stock runs up in price, pulls back down a little bit below that recent high, kind of forms a base anywhere between 2 to 4 weeks or so, sometimes a little bit more, sometimes a little bit less, and then breaks back above that most recent high. That's called a breakout, and we want to catch a stock right when it's breaking out like that. And if you know how to read the charts, and I've spent a lot of years learning how to do this, you know exactly where the place is, or you don't know, you never know exactly the right thing. Sometimes you're a little bit off a day or two, whatever, but you can pinpoint a good time to buy a stock much more so than if you just didn't look at the chart or if you didn't know how to look at the charts. So another bullish pattern here is a flat base. That's when a stock kind of bases out and, usually an uptrend and just kind of has like some good base 2, 3, 4 stage bases. And then we have a double bottom. Okay. That's another big, very bullish, powerfully bullish. Okay. And I'm going to be showing you some charts here that have these patterns, so that it's not just an abstraction. So we use the charts to determine whether now is the right time to buy. And if it is, then we take the next step there. And the next step is what's called industry leadership. So when you're hot, you're hot. Okay. A lot of industries right now, especially like for example, energy is a hot industry right now. We've had a lot of energy positions, natural gas, utilities, things like that, because that is where the earnings growth has been. And that's also where the relative price strength has been of late. It's not the only sector. There's been healthcare is good. But traditionally big sectors that we used in the past, like technology and telecommunication services, software, cloud stuff, not good. Okay, social media, not good. All that stuff is on a downtrend. So there's no industry leadership there whatsoever right now. In fact, it's a laggard, and that's where we're actually hunting around for put abilities. And I'll show you one of the puts that we just closed out there, because those are the opposite. Those are the companies that have the opposite characteristics of the call side. Okay? So we want to know where the smart money's shopping. Like if you go into a bookstore and you see a bunch of people congregating around the bestseller area, that's because those are the hot areas. Okay, people aren't congregating around the bargain basement stuff that they're trying to get rid of for $1 or $2, whatever. Sometimes you can find a hidden gem in there, but most of the time, if you're looking to find out what the hot read is that summer, then you want to go to the bestseller list. And that's what we do in the service for the calls. Okay. All right.
So Jim, let me ask a quick question on the put
Sure.
side, since you just mentioned it. So on the bullish side, you're looking for the top 20% in price and earnings and the leadership. Are you looking at the bottom 20% on the puts then?
Yes, quite perceptive of you. Well, I'll get into that in a moment, but we essentially reverse the process for the puts.
All right. I jumped ahead.
Yeah, you jumped the gun, but that's okay. I mean, that's what a good publisher does. So I know you're just excited too. So we'll get to that in a moment. But essentially, that's exactly right. We do look for the bot. Because if I can screen for the top 20, I can screen for the bottom 20 just as easily, and that's where a lot of good put ideas come from. The other element to the mix here, which is for the put and the call, and actually almost more important on the put side of things, is this final factor. It's what I call news queue. Okay. Now, there's a famous saying that the medium is the message, but my friend Penn Jillette says the medium is not the message. Okay, the message is the message. Okay. Now, if you know how to read the message of the markets, you're going to have a big leg up on what goes higher and what goes lower. Okay. So news cues, everyone knows what IQ is. I have what's called news queue. Okay. Now, I define it as the ability to take the pulse of the market, either on a specific stock or industry, to see if there's enough positive or the absence of negative news that can drive the stock higher. Now, on the flip side, Roger, if there's enough negative news to drive the stock lower or absence of positive news, then that's the ones you want to look at for the put option opportunities, because those are the ones that are likely going to keep on going down. I'll show you a couple examples of that news queue in play here in a moment. So it's I call news queue part science, part art, part market awareness, but most importantly, something that you need here is a lot of applied experience. Okay. It's not, you can't just start reading the news queue and like, oh, okay, I know exactly what's going to happen. No, you have to be in this game for a while, like 3 decades or so, like I've been in. You don't need 3 decades to learn how to make money, but you need the more experience you have, the more you've seen things play out, the more you know how things are going to play out. Like, for example, when I was a trader in the late 90s, we knew that there was going to be a blowout in the .com because there was nothing supporting it other than wishful thinking. So we made money as these stocks ran up, but as soon as they started to kind of roll over, we started shorting them, started buying puts, things like that. And we made a lot of money on the downside when everybody else was hurting, because we knew it wouldn't just come back. We knew that there was nothing substantive there. So even way back then, and a couple of decades ago, the news queue, reading the news queue is a very important thing. Even more so today in a market that is like dangerously susceptible to news of all sorts, Putin, China, and the Fed, hurricanes even like we had today. So these things all affect the market. So if you know how to apply the knowledge that you have of them, you're going to be in good shape. Okay, so what about the puts? Okay, so the put options, we basically reversed the process here, identifying the stocks with declining fundamentals, bearish price and technical patterns, and particularly negative news queue. Okay. All right, let's look at a few examples of these things, real world examples. So Peloton Interactive, that's the exercise bike. Okay. So this is one of the first positions that we entered into when we began this service. And in December, I knew that we started, the first part of the year was when basically when the world opened up again. It started to open up again, at least. And people wanted to start going to the gym again. They didn't want to be hunkered down in their house. So we knew Peloton would come under some earnings pressure. But then a really interesting piece of news queue happened. There was this new series, this new Sex and the City spinoff, and one of the main characters was killed off after they showed him riding a Peloton bike and having a heart attack and dying. So they killed the guy off based on his Peloton experience. Now this is fiction, of course, but a lot of people watched that show, and a lot of people became a little bit weirded out about the Peloton thing, and the stock sold off sharp. And I mean, real sharp. Like you can see here, the chart, look at what happened from mid-December all the way to mid-January, and right before, it made a rebound in February, but by then we were out. We had this stock we had this put option for 21 days, and we banked a 59.47% gain in that. So the news queue, we got it right. And we got the right timing, and we knew, but also knew that the stock's earnings were starting to come under pressure, and of course the price, because people didn't want to buy Peloton bikes anymore. They want to go out in the world and interact. So it's an example of all of the different things that I talked about, earnings and technical pattern, whatnot, on the downside. Okay, so there's one example. So here's some more examples here. Now, we bought the calls for the equal weight S&P 500, the RSP, bought those in December and sold those 21 days later for an 81.56% gain. Okay. Now, the reason why we did this is we saw the market. If you look in this chart here, mid-December, the market started breaking out a little bit, and it went all the way up until about the first week of January. Well, that was like the end of the year 2021 push. And since then, the market has not done well. but we knew that the market started to break down right around that January. So we got out of this call and we banked that 81.5% gain. So that's the news queue element too. So this was a put option on the entire market. So rather than just earnings on the specific thing, we saw that the news queue was positive to ride that wave higher. But when it started breaking down, we got out with a big gain. Okay, Walmart is one of my favorite companies. They're a juggernaut. They're a really good stock now to leg into as a long-term play. But in this case, we held it for about 23 days and we made about an 88.75% gain in the March calls. And here again, we took advantage of that December surge higher at the end of last year. Okay, gold. All right. Now, gold has had a hard time of it of late, but in January, it had a really hard time. So you can see here that mid-January, about January 11th or so, is when we entered into a put option on the gold miners ETF. That means we were betting that it would go down. The next 17 days, it did just that. It went down, and you can see here on the chart, it tanked. Even though it pushed up a little bit higher, it actually went back down sharply after that. By the end of January, it was down pretty significantly. And because of the leverage of the call options, we managed to make a triple digit gain here of 103.77% in the March $28 puts. So this is how you take advantage of the market. This is how you're quick and not dead in the market. Okay. So this is how you're quick and thrive. Okay. Because in this market, you got to be quick or you're going to be dead. All right.
And now I have that song in my head.
Yes, I know. Well, at least it's a great song. Yeah, if anyone wants to hear that song, just after the whole day's over, and we're done with the summit, then you can.
Might not be for everybody, but
it might not be for everybody, but it'll make you think. So, because it's a good video. No. All right. First Trust Dow Jones Internet. This is internet stocks. Okay, everyone knows that internet stocks have been hammered this year, and they started getting hammered about the first part of the year, like January, specifically January 18th, when we bought a put option on the FDN. Okay, and we held it for 6 days only. Okay, why did we only hand it for 6 days? Well, when you make 128.57% in 6 days, you need to take that. You need to be quick and be great and not be dead. You do not want 130, almost 129% gain in 6 days to evaporate. Sometimes you have to
be like Steve Miller and take the money and run.
There you go. Take the money and run. Yeah, this is its definite case of take the money and run, because now, as it turned out, you can see that, we sold this in January 24th. Then the market bounced back up a little bit. That's one of the reasons why we actually started. We went and took that profit, because I did see the market go back up. It went up for the next week or so. You see, like on this chart where it says February, it went up a little bit, but then it tanked back down. So, but that's okay. So we already made our 128.57%. So when you have a gain like that, usually it's smart to capture it, especially if you see it going against you at all. Okay, here's another one. The Energy Select Sector Spider. I mentioned energy was a big positive sector this year. It's been the one sector that's actually outpaced the rest. It's one of the few sectors that's up on the year. So we saw that energy was starting to break out. We saw that in early February 8th to be exact. And we bought we bought the April 73 calls on the XLE, which is a basket of the top energy stocks. And in 24 days later, we had 146.88% gain there. And all these are, verified actual numbers. So we calculate these all the time, make sure that everything is spot on, because we're really proud of this track record. And we really know that if you follow my buys and sells, you're going to have results along these lines, just along with us, because that's exactly how we track it. So 24 days, 146.88% in the sector that was breaking out. So this here we not only looked at a breakout technically, but we also knew that the news queue was such that energy was spiking, and so that's when we knew we had to take advantage of the energy space here. And subsequently, we've bought a lot of different energy calls over the last 6 months because that is what's been doing well. Okay, here's another one. Alibaba. This is a Chinese internet like eBay kind of site, Amazon type of site. It's a great site actually if you need something, but it's been very volatile, especially of late because China's had a lot of woes in their economy. But in May, we saw a big run higher in Alibaba, and I identified that run higher, and this is off a double bottom technical pattern in like mid-May or so. And so from May 17th to June 8th, which is just 22 days, we were able to bank a 235% gain in the July 105 calls. Here again, we had the timing right, we had the relative strength right, we had the technical pattern right, and that's when the one time area from May to about July when Chinese stocks started doing well. Since then, they have not done well. They've been getting sold off very hard. But there was a period of rebound here, and we took advantage of that period. All right, now here is this is the last example here, and it's the most recent example, which we just closed out on, I believe it was Tuesday. So, 9/23. What was that? Was that?
That's Friday.
That was
Friday.
what?
Friday last week.
For last Friday. Okay. Yeah. Thank you. So, VanEck Semiconductor ETF. Now, what was I saying earlier about technology stocks being the ones that have come under the most pressure of late? Well, no subsector of the market has come under more serious pressure. One of the sectors that's come under some of the most pressure is semiconductor stocks. Okay. So the VanEck Semiconductor ETF is a basket of all the semiconductor stocks. Well, in August, late August, you can see here, look at the chart here on SMH, right where that blue line is, and around the end of August, that's when it broke down below that 50-day moving average. So that was a technical trigger for me to know that, or to suspect that the market would punish the semiconductor space. And that's exactly what it did for the next 24 days. And even until today, that sector is getting smashed because it's a risk-off trade. But what happened? To take advantage of that, we bought the November 196 puts, and the subsequent 24-day gain was 83.35%. Okay, so here again, a combination of technicals, price, relative price, and earnings as well, because a lot of these companies in the VanEck Semiconductor ETF had struggled with earnings per share. Supply chain issues, China issues, all of these things pressured semiconductor space. I suspect that area is going to continue to get pressured. So we were able to capture that big gain in 24 days. So that, as you can see, this is like kind of some of the typical type of results we've got. Now, we don't get them all right.
Real quick, Jim, 5 minutes.
5 minutes. Okay, 5 minutes. All right. So we don't get them all right, of course, but here are some of the greatest hits. As you can see, there was a lot of triple digit wins there. And that doesn't even include that SMH one from before. We've had a total of, I think 35 trades, and over 20 have been profitable. So we're at about a 60% win rate here, and with big numbers like this. So it adds up quick. All right, so here's a cheat sheet, what I call the cheat sheet. This just goes over all of the different elements of what I just told you. For calls, we screen for the relative price strength, strong earnings growth. We buy on bullish breakout patterns. We buy on bullish news queue. We buy out of the money call options, and we hold until the momentum ceases. And then for the puts, we basically screen for the declining fundamentals, the bearish price and technicals, and the negative news queue, and we buy out of the money puts. Okay. So that's the key right here. So take a screenshot of that cheat sheet right there. You know what the essence of this service is about. Okay. Now I won't go through this. This is just a little bit about my background. Some of you know about this already, so we'll go quickly. The thing to point out here is that I've had now 25, almost 30 years of experience in the industry. So that's you learn a lot through your mistakes over that time. So hopefully those mistakes will help me make you money.
And what Jim, oh, there it is.
Yeah. Oh yeah.
I was just going to talk about tip ranks.
Oh yeah. Okay. Well, yeah. No, I don't forget. I won't forget how. That's this one, Roger. So this is a little chance to boast and to make fun of myself a little bit. There's an independent firm called Tip Ranks. They look at people like me and other advisors throughout the industry, and they say, well, who's done well, who's not done well. They calculate our wins and losses, and they recently ranked me the #1 blogger out of more than I think it's over 7,000 people. So there's my success rate. Now this is through a lot of my different services, not just the high velocity options. But the thing to note here is my kind of Game of Thrones-esque haircut in this picture. So I look like I should be in a Targaryen riding a dragon. So, but
you're the dragon slayer of markets.
Yes, taming the dragon is something that I pride myself in being able to do with this market. So the world's a dragon we can tame is one of the things I say often. So, all right. So, last thing is to remember this is fun. Richard Branson is one of these guys that has a lot of fun making a lot of money. And if you want to make a lot of money, you need to have fun doing it, because if you're just trudging away at this thing and you're too nervous, you're too worried about every little down day, every little up day, you're not going to be successful. You have to have fun doing this. And you can probably tell I have a lot of fun doing this, a lot of fun making money, helping investors do the same. And so if you were to subscribe to this service, or if you have my other services, you know that we're all about good knowledge, good information, good fun, and interesting content that helps you make money. Okay. So now here's the most important slide of the day. We have a special today. I know Roger's been mentioning these things throughout. We have specials. So regularly this high velocity option service is a high-end trading service. We usually charge about almost $2,000 per year for it. For today, because you're on this event, we have a special intro offer. Get started with it, $90 for the first 90 days. Okay. Now that is a no-brainer. If you want to spend a good $90, spend it today, because you're going to find out a lot. You're going to be able to, you'll unlock the secrets to the buys and sells that we use in this service for what, less than a dinner. So
yeah, and to subscribe, you can just click on the box that's in the chat box, the link to get that offer. That's the only place you can get $90 for 90 days.
Yes, exactly.
We don't have that anywhere else. It's a special for today's event. So click the box in the chat, and there's also a box hanging there in the top of the chat as well. But exactly. one of those two, click there to take advantage of this offer. It's a terrific offer, and you want to make, Jim just, talked about it, 60% wins in this year in this market. I mean, and he's up when the market's been way down, but that's how he does it with these 5. It's very simple if you think about it. The concept of it is simple. The execution is not. That's what Jim is for. But to screen all these things, and you're getting the best of the best or the worst of the worst, and you can take advantage on the positive side or the negative side, and that's how you come out ahead in this market. It's exactly what Jim has done this year, and he's been doing it since we launched this service. So click on that button now to take advantage of this offer. And Jim, we're at the end of your time, so I want to thank you so much for being part of this very exciting day and helping educate our viewers out there. And as you said, let's have some fun and make some money.
Yeah, exactly. All right, thank you, everyone. I appreciate it. Much gratitude to all, and come join the party. We love it.
All right. Well, thanks, Jim, and we will be back in just a few minutes with Lincoln Holbrook. And we'll talk more about that in a second. And if you haven't, hit that subscribe now button below this video to subscribe to our YouTube channel. And we'll be back in just a few minutes. Well, welcome back. We're having a great day here. So excited about our first live virtual event here on our YouTube channel. Remind everybody to hit the subscribe button right below this video to subscribe to our YouTube channel and make sure you get up to date on all the free content that we're putting up there. As I've mentioned a few times today, this is all about education. We want to, you'll be a better investor if you're more educated, and this is a perfect segue into why Lincoln Holbrook from Consistent Profits, while he is not one of our advisors officially at Eagle, a really good friend of ours, and he's really good at training people on how to trade and doing one-on-one trade, training, and he's got some really good insights into what you need to do to be successful. And so his presentation, as you see on the screen, is Rig the Markets for Your Success. So Lincoln, take it away.
Thanks, Roger. And thanks for inviting me onto this. I appreciate the opportunity to share what I've learned over the last few decades, teaching thousands of people how to trade. And I was on for the roundtable, and I just really think I'm just so impressed with the kind of talent that you've brought in for people to learn from and to get help from in their trading. And just so impressed by you as a person as well. I just love who you are, and I love being able to work with you and be your friend. So
thank you, Lincoln, and I'll send you that $20 bill. That no, I really thank you very much for that. That's very nice.
You're welcome. I know that there are a lot of people out there who feel like the markets are rigged against them. And you probably feel that way because the markets are random. They move randomly, and it's hard to gain any sense of control over them and any sense of confidence in your ability to get a predictable or repeatable result even. But why should I know that, or why should you listen to me? Just very quickly, I have been training people how to trade since Invest Tools way back in 1998. We did their first event at the very beginning of 1998. Since then, I've gone on to travel the world at their workshops, training people thousands of people personally how to trade. I saw the struggles that they had. I saw the issues that they had. I felt the questions, and I answered the questions that they had, and they're so similar. 2013, I also started a new company, and the goal of that company was to figure out why so few people are able to trade. And Roger and I have success in trading. And Roger and I have talked about this before. Some people love the alert services, and other people don't love those alert services. That hasn't worked as well for them. Why? Why do people struggle to have the same results as others? The same success with alert services as others do. Well, I've seen that struggle, and I've tried to answer that question. I've spent years, since 2013, I've interviewed thousands of traders. I've worked with my trainers that I hired. Why? What's missing? What's the struggle? We're teaching these very simple systems for people to follow, and yet it's so hard for them to actually follow them. Why? And it took me a long time, but I finally cracked the code, and that's what I'm sharing with you today. To get started, I just want to ask you a question. What drives your trading? Okay, a lot of people make trading decisions based on FOMO. So I read a study that about, 60, 70% of all the people who own crypto in their retirement accounts bought it last year, right before the crash. Are you making your trading decisions based on the fear of missing out? Do you have a need to play catch up? Are you behind where you thought you would be financially, and you have this fear that you're not going to ever be able to quit working because your money isn't working hard enough? And so you just have this impending feeling of doom, and you're trying to catch it all up. So it's human nature. I think there's a song out there, I want it all, and I want it right now. It's very human nature to want to catch up. Some people, they get confused. There are people out there every day who are buying a stock, and people out there every day who want to sell that stock. And both sides have big megaphones, and those big megaphones can be very confusing to people. And so they get paralyzed. They want to take action, but they struggle to take action. And then a subtle issue that a lot of people face is this need to be right. How many trading decisions have you made out of some sort of defensive mechanism or the need to be right? So we're going to talk through some of that and why it's so important that you start to change your thinking a little bit. And we're going to show you how to do that. Most of us as humans desire to control our environment, right? And we've learned from very early ages how to control our environment. If you want to get better grades in school, what do? Well, you study harder. If you want to get stronger, what do? Well, you exercise. If you want to quit smoking, what do? There are very specific, usually direct elements that you can control to get the outcome that you want. Well, it's only natural that if you feel any sort of pressure, you're going to feel a need to create control or to control over a desired outcome. So I need to make more money. I need more money. So how do I get more money? And a lot of people will immediately think, I'm going to go get a better job, or I'm going to go to school and get a better job, or I'm going to get another job. It's all tied into their income stream. And that's how they look to gain control over their financial future. Problem is, at some point, Wall Street just fails you. And these same people realize, I am out of control. My financial future is not at all where I thought it would be. In fact, I may have to work until I die, or I'm going to run out of money before I run out of life. That also it happens. And so these people feel like they're being forced into the markets, and they look for ways to control or directly control their trading results. And they look for that through invest tools. They spent several $1,000s and 2 days of their life trying to figure out how to trade. They're trying to learn about it so they can control the outcome of it. And I've worked with all kinds of publishers. I've worked with all kinds of experts to build educational programs around their approach to the marketplace. And they all had one thing in common. They all had a sincere desire to provide a value to help you gain control over your investing. The struggle is they also all had another thing in common, which is they were all incomplete. They did not allow you to actually gain control. Very few people, in my experience, have ever been successful or ultimately successful with these trading educational programs or other alert services. And that's because most people who have been trained throughout life to gain control over their outcomes by direct control, right? Looking for those things that give them direct control over the outcome that they want, they are still trying to do that in the marketplace. And so they spend a lot of effort and a lot of time, and in some cases, a lot of money trying to find what I would call the perfect entry signal. You know, the one that never misses, that always wins. So there's some people have stress about money. They have fear about losing money. They have a fear of loss that's real, and they want to control their outcomes. And so they look for entries. The challenge with that is that the markets are so big and so random that they are impossible to control, and they're impossible to reliably predict, you know, what direction they're going to go, because they're random. Ray Dalio, a super successful, one of the largest, most successful traders of our time, wrote, "He who lives by the crystal ball will eat shattered glass." And I just liken that to if you're only focusing on your entry signal as the way to make money or to get consistent results from the marketplace, it's just impossible, right? If you don't have anything else as part of your process, you just won't be able to have very much success. The challenge is, because what I'm sharing with you today hasn't really been out there, there are a few places for you to learn this stuff and a few ways for you to really get access to it or to understand it, so you can start having a better conversation with yourself about your own trading. To control their results, most traders put themselves under enormous pressure to find perfect entries, but at the same time, they also have this toxic inner narrative about all their trades, even the profitable ones. I once spoke with a guy. He told me he was so frustrated because he'd lost money on a trade. And so I dug a little bit, like, what do you mean you lost money? Turns out he'd bought it at like $50. It had run to $70. It was now trading at like $65. So in his mind, he had lost $5 on that trade. He was up $15, but he was down in his own mind, in his own narrative, he was down $5. Well, if you have that kind of a narrative, how could you ever possibly hope to be successful? That puts you under so much pressure. You just constant pressure to be perfect. right? To avoid loss, to capture the very most, the very low and the very top of a move. It's just very, very difficult to be successful when you're under that much strain, under that much stress, under that much pressure. Benjamin Graham once said, successful investing professionals are disciplined and consistent, and they think a great deal about what they do and how they do it. Now, notice in that quote, there's nowhere in that quote where he talks about an entry signal. There's nowhere in that quote about successful investing professionals that talks about finding the perfect entry or the technique to find the perfect entry or the approach to find the perfect entry. As proven by successful investors over the world, there are many, many different ways for a person to find success as a trader, right? But those who find success have a process, a complete trading process, we call it. And that's very important that you have one and that the one you have is custom tailored to you. Because if it's not, you're not going to be able to trust it and keep following it during winning streaks and during losing streaks. Further research in today's a little bit early, just a few years ago, a guy named Jeff Colvin wrote a book, Why Talent is Overrated. And in that book, he wrote, the best performers make the most specific technique-oriented plans. They think exactly, not vaguely, of how to get where they're going. This applies to any endeavor in life, including trading. So think of it this way. The best traders make the most specific technique-oriented plans. They think exactly, not vaguely, of how to get what they want in the marketplace. He went on to say that the poorest performers don't set any goals, that mediocre performers set goals that are general and often focused on achieving their desired outcome. I want to be rich. I had a friend of mine who used to call that fantasy. There's a difference between mental creation and fantasy. Fantasy is you think about where you want to be. I want to have $1 million in my trading account. And then you progress beyond that as to how much better your life will be now that that's achieved. And that's fantasy. And it feels good. It's a feel-good thing. It makes you feel good until the phone rings, until the baby cries, until something happens. And all of a sudden you're pulled out of that fantasy and you're having to deal with this opposite chemical that's released by your brain, which creates a lot of extra stress and pressure. The difference between fantasy and mental creation is that mental creation goes to that place. I want to have $1 million in my trading account. And then it goes backwards towards now and thinks of every step that has to be followed in order to achieve that goal. So it hits it mentally, you think about that, but then you come back to today and you start building forward all the things you're going to do to achieve that. And that's what Jeff Colvin says, best performers set goals that are not about the outcome, but rather about the process of reaching the outcome. So you have the outcome in mind, but then you develop a process to help you achieve that outcome and you stay focused on the process. It's very easy for traders to get focused on the outcome of individual trades, whether it was a profit or a loss, and to have an emotional reaction to the profit or the loss. That's very normal. But the best performers are not focused on the trade outcomes. They are focused on the process, right? Of how well did they follow their process. The rewards that they feel from their trading come from how well they followed their process, not based on whether or not they had a profit on an individual trade. They have come to realize that if they have a complete trading process, they can bulletproof that. They can test it without money. And then when they implement it with real money, they can trust it enough to follow on every trade to give them the expected results. This is what I discovered as part of my research. I discovered that in order for you to get control over your trading results, it's better for you not to focus on individual trade outcomes, but instead to focus on the entire process. It's better for you not to focus so much on the entry, but rather to focus on the exits and when you take your profits and when you take your losses. A lot of people will let a profit turn into a loss because they don't know where to take profits. Other people let a small loss turn into a very large loss because they don't know how, they want to be right? They don't know how to get out of that trade. And so they waste a lot of time in unperforming or underperforming positions because they don't really have a specific or complete trading plan. What I found is that there are 7 elements of a complete trading process. One of them is market dependent, which is your entry signals, which is alert services provide, and the ones that at Eagle, the ones that from the Roger has put together a great team of people who know a lot about the markets and can give you great trade ideas and to help you see things that maybe you wouldn't have time to see any other way. But as valuable as that is only one component of what you have to have in order to be completely successful. I met a woman once who had subscribed to numerous newsletters, and she had done very well with those newsletters, but she was getting ready to retire, and she realized, I have hundreds of smaller positions in the stock market, like stocks I have positions with 20 shares, 50 shares, 100 shares. And then she had one of her positions represented 40% of her overall portfolio value, but she didn't really have a plan for protection. She didn't have a plan for, what do I do now? What if it goes against me? How do I get out? How do I protect myself? She had just depended on the bull market, which, as we heard earlier, that may not be something we can depend on, at least in the near term to intermediate term. Anyway, so that there's some additional steps that should be a part of your complete trading process. One, you need to understand, what is your base winning percentage? What I mean by that is, given what you know about your entry signals and your exits, what is your break even, right? How many trades do you have to win in order to break even? So your account doesn't lose. Most people cannot answer that question. Well, that question is answered by what's your average size profit versus your average size loss, right? If you have an average size profit, for easy math, that's 2, and your average size loss is 1, you're risking 1 to make 2. Your base winning percentage is 33%, meaning if the markets remain random, you are going to win about 33% of your trades. Now, some people will freak out at that low number and say, whoa, how can you be profitable at that? Well, part of that is going to come in the form of, what's your edge technique? Are you winning more than, if you expect to win 33% of your trades, but you're actually winning 40% of your trades, you have a 7% edge. We're going to talk about that in a minute. I'm going to have a calculator to show you that you can do some amazing things once you understand how the levers work. You need to know how much you're risking per trade and make that consistent on every trade. And you need to know what your annual trade frequency is. Most people can't tell me what their goal frequency is. And they don't understand just how important that number can be to their overall results. We're going to talk about that. And then there are and those are all market independent. Those will happen no matter what. The markets, in random moving market, you can prove this to yourself. We prove this with all of our clients. We have them do an exercise using the chart game, and it proves to them that they can start getting predictability out of random entries. The other enhancers are asset class selection. Are you diversified enough? Too much? Allocation per position. In other words, if you have a $10,000 account, how much are you willing to allocate into any one of your trades? How many trades are you going to divide that $10,000 into? And journaling. Most people think of journaling as an impediment to their success. It kind of gets in the way of profitability. But in fact, journaling is a key to success because it allows you to evaluate your progress over time. So you can, number one, monitor how well your trading process is working, and 2, continually refine it, improve it as you learn new things and as you become better able to follow it. Now, it's possible to rig the markets for your success if you're approaching your trading with specific, not vague expectations and rules. Now, we're going to go to a calculator and talk about expectations and rules here in a second. When you can gain confidence about your trading process because you're comparing the results you actually get over at least 30 trades or more compared to what you expected to get. If that matches, well, then you can increase your confidence in your system and keep going. And finally, if you employ a feedback loop, the journaling, so you can monitor your progress and continuously improve your results over time. Now, this calculator we put together because we wanted to show people some very specific things. Notice we call it Get Specific About Your Trading. Most people don't have any form or very small form of specificity about what they're hoping to accomplish in the marketplace. So let's talk through 4 of the things of the 7 pillars of control. Let's talk about 4 of them. 3 of them are enhancers. They're allocation, asset class, and journaling. They don't really tie directly into your trading or individual trades, but let's talk through what this looks like so you can, using this tool to develop an overall trading process, or what I call a complete trading process. Let's just assume you have $25,000. That's what this number here at the top is in your trading account. And let's further assume, I'm doing this on purpose, we have 5 different types of trading styles that my research has identified. Everywhere from I'm going to risk losing a lot of trades in order to have a few big wins, all the way to I don't want to lose anything. I want to win most of my trades, but I'm okay with small sized gains on individual trades. I'm willing to take the risk of a few larger losses on my trades. I just don't want to lose very much. I feel I'm in control if I'm winning most of the time. And most people, when I've talked to them, they're just like, I just want to feel like I have consistency, right? I'm just looking for consistency in my trading. But we're going to use, for an example today, a win frequent extreme. You're risking 1 to make 3. In that scenario, your base win rate, or the win rate you have to have just to break even, the win rate you would naturally have as part of a random entry. If you're just selecting 30 random entries, you will win 25% of your trades. Okay, that means you're losing 75% of your trades. Is that a trade-off you're willing to make? Well, that's what we're going to talk about. They're all trade-offs, but you're getting very specific. Number 2, what's your trading edge? Right now, I have this as a 3% trading edge. I haven't done the research, but the alert services you get at Eagle or other places may be more than 3%. But do you know that? How would you figure that out? Well, you figure that out using other calculators that we have that we can share with you and teach you. How much are you risking per trade? Well, I talked to a guy. I said, do you have a standardized risk per trade? He goes, yeah. If I feel good about a trade, I'm going to risk 10%. And if I don't feel so good about the trade, I'm going to risk 5%. And I just kind of scratched my head for a minute and said, well, why would you ever get into a trade that you would only risk 5%, right? Why don't you just trade the ones that you really feel good about? He did not have a standardized risk per trade. He did not understand. And when I say 1%, what I mean by that is of the total account size. Annual trade frequency, in this case, a couple of trades a week. What if it's more than that? What if it's 3 trades a week? Or what if it's 4 or 5 trades a week? We're going to show you how that has an impact down here on your expected annual rate of return. Now, if you have a 3% edge, you're winning 25% that's your base win rate. A 23% edge means you're winning 28% of your trades, which means you're going to be losing 72% of your trades. And then you have an average risking 1% or $250 per trade in this scenario, and you have an annual trade frequency of 100. That gives you an expected 12% annualized rate of return. I talked to a guy once, and I showed him how to get a 12% annual rate of return. And he's like, I've always seen those calculators that tell me what my money could look like if I had a 12% annual rate of return, but nobody has ever broken it down into these steps so I can quantify just how I can impact that. They show you this piece over here, right? They don't show you how to break it down to get that number. So let's assume that Eagle's going to be able, the publications you get at Eagle give you a 5% annual rate of return. What does that do to this number down here? Well, it turns it from 12 to 20%. A 2% increase in your trading edge gives you an 8% increase in your expected annual rate of return. But it doesn't give you a whole lot of nest egg if you only have 10 years to compound that. So what if you need a bigger nest egg? What can you do? Well, the easiest thing to do would be to increase your annual trade frequency. Let's just bump this up. Instead of 2 trades a week, let's just do 4 trades a week. Look what happens to your expected annual rate of return. It jumps to 40. Increasing your frequency increases dramatically your expected annual rate of return if you're controlling all the variables we teach you how to control, right? So if you're with Eagle and you have a subscription that's giving you a couple of trades a week and you know you need to increase your frequency, well, who could you turn to to get a higher number of trade alerts per week? Well, of course, Roger has lots of things he could talk to you about with regards to increasing your
Amen.
frequency. Well, look what happens if you could increase your frequency. Look what happens to your nest egg over here. Okay. So you're still risking just $250 per trade. That's standardized on every trade. You are monitoring your trading edge because you're journaling and you're keeping that trading edge. And then it's just a matter of increasing your frequency to get the number that you're looking for on this side. It's important, if you want to be overall successful in the markets, that you have a very specific understanding of what are the trade-offs. If you take a system like this, a win big extreme system, you're going to lose a large number of trades. Well, losing a large number of trades means that you'll have more opportunity for loss, which means that you're losing streaks because randomness comes in streaks. They're unpredictable in size and duration, but they are statistically within ranges. And when it comes to streaks, you can say to yourself, okay, if I have a larger losing streaks and my losses are going to come more frequently, I have to be prepared for a maximum drawdown. What's my largest potential maximum drawdown? That's one of the things we teach you how to determine. So then you can say to yourself, well, if I'm going to do this kind of a style, I can't risk any more than 1% per trade. So if you have a few trades in a row, you have to understand if you're risking 1% per trade, what that means is you're putting, say, $250 at risk on this position. When you get $500 profit, you're out. The amount you risk per trade caps your overall profitability. And you are going to be tempted on your winning trades, especially during a winning streak, to increase the amount you risk per trade because you feel like this is capping your potential. But you have to be focused on the process of making sure you get what you want, not the outcome of individual trades. Now, it's easy to say all of this, but it's hard to actually do it. That's why Warren Buffett once said, trading is simple, but not easy. Finding success as a trader is simple, but not easy. It's not easy because you're going to be tempted to increase your risk per trade during winning streaks. You're going to be tempted to give up during losing streaks, and you're going to be tempted to not do as many trades if you can't handle a high losing streak, scenario, approach to the marketplace, right? A high losing rate.
Yeah, it sounds like
Let's
it's
go
all
back to
about,
go
sounds
ahead.
like it's all about discipline and keeping the emotions out of it. And if you have a plan and follow the plan, those other things that shouldn't be in there go away because you have a plan.
The plan helps. Let's put it that way. If you want to lose weight and you say, I need to lose 20 pounds, right? And you just kind of have a general idea of what you want to do. I want to lose 20 pounds, but you don't have a specific thing other than maybe your doctor's told you you'll die if you don't lose those 20 pounds. Well, if you don't have any specific plan for losing those 20 pounds, that weight of your doctor's pronouncement, you're going to die if you don't lose these 20 pounds, is going to be on you. But you're just going to be spinning in this juice of fear and stress and discomfort and maybe even overwhelm. But having a specific plan, so maybe you're going to hire someone to help give you this specific plan, right? You're going to hire a dietitian. Maybe you're going to hire an exercise coach, right? To help you get a handle on what do I need to do? How do I even do this, And so when you finally can get to that place where someone's showing you how to do it, you start having a better conversation with yourself. Do you remember how I told you that most people that I've met with thousands of people, most of them have a toxic mental, their narrative about their trades is toxic. If I were to say those things to you that you say to yourself about that you're trading, would you even want to talk to me? Would you ever want to be my friend? I doubt it, right? Most people are that hard on themselves when it comes to their trading. So there are patterns of behavior, learned patterns of behavior that all of us have, and there are learned issues that all of us have. And we all bring a unique lens, a filter through which everything goes through that blinds us to certain things and also opens up our vision to certain opportunities. We have to be aware of that. Now, Michael Burry, and he's not the only very famous investor to say this. He's the author of The Big Short, was the star of it. Not that he starred, but his life was turned into a movie. He once wrote, if you are going to be a great investor, you have to fit the style to who you are. At one point, I recognized that Warren Buffett, though he had every advantage in learning from Ben Graham, did not copy Ben Graham, but rather set out on his own path and ran money his way by his rules. This is very important. Going back to Roger's statement, if I'm a person who hates to lose in the marketplace, I'm just so afraid of loss, and I adopt a system, I am going to have a hard time having confidence in that system, and I'm going to have a hard time following it. In fact, I'll likely sabotage my own efforts to be successful using that system. I have to know who I am as a trader in order for me to be able to align my approach in the markets to who I am, so that under the press and stress of trading, I'll be able to actually have some overall consistency, right? I'll be able to, the parts of me that are aligned together then will support me and my efforts to be a good trader. They won't sabotage me. All of this is mostly subconscious because most of our brains process so much information subconsciously compared to our conscious minds. Now,
Just so you know, Lincoln, got about 9 minutes.
okay, thanks. I won't take too long on this section, but just know that my research identified 5 different approaches in the marketplace. We talked about some of the extremes: win big extreme, just win, and win frequent extreme, and then there's win big and win frequent. And to identify who you are as a trader, we ask you 2 questions. This is one of the 2 questions. You discover a fun-looking game on your smartphone. You're intrigued, so you download and play. It's fun but challenging. You estimate it'll take an hour to develop a skill to really be good at it. What do you do next? Write down your answer. Which one would you do? This is the second question. And if you can't write down the answers quick enough, just for time, it's okay. You can reach out to us later, and we can go through this with you slower and make sure you understand everything. You're with a small group of people you feel comfortable with. A good friend asks you to share a talent or skill that you're pretty good at, but nobody else really knows you're good at. So what do? If you hesitate but share after some encouragement, write down a 4. If there's no hesitation, but you watch for their reactions, write down a 3. If you hesitate before starting to make sure you can do it right, write down a 2. And if there's no hesitation and no thought for others' reactions, write down a 1. I know that I went through that pretty fast. But this is how we determine what kind of a trader you are, and then we help you understand what strategies best align with who you are, what you individually bring into the marketplace. Everything we do is personalized for you because you're the one that has to actually follow the process. And if I try to impose a process on you that I think is good for you, you won't follow it. There's a little voice in your head that says, no way am I going to follow that. I didn't do it. Or there's a little part in you that doesn't believe in it. So you're going to stop following it because you don't believe in it. But if you build a process that's geared to you as a person, and you understand what you're doing and the trade-offs that you're making as part of that build, then you'll be better able to follow it, even if you have a losing trade or a few losing trades in a row. Depending on where you put your answers, you would have a different kind of trading spirit animal. Win frequent extreme is like a dragonfly. They win about 90% of their hunts. That's win frequent extreme. Win big extreme is like a polar bear. They only win about 10% of the time when they go out hunting. And then there's stuff in between. Now, the struggle that many people face when they get into the marketplace, and like I said, many people are forced into the marketplace. And there's the information that we teach, like I said, it's so revolutionary. I've been doing this for 25 years, and I spent years and lots of money trying to figure out what was missing. And it took me a long time, even with my background, even with my experience, even with my network of people that I know, to figure this out. So for most people who are forced to get into the markets, or who choose to get into the markets, whether they're new or whether they've got some experience trading can kind of feel like an elephant, right? You glom onto one thing, and that's the thing, right? Maybe it's position sizing. Maybe it's top-down analysis. Maybe it's value analysis. Maybe it's some sort of strategy. You're going to sell short only, or maybe you're going to go long. Maybe you're a day trader. Maybe you're an intermediate term trader. You just glom onto one element and think that's all you need to know to be a great trader. That's all you need to do to be a great trader. But great traders, the truly great traders, don't just have one thing. They have all the things. They understand what moves the market, and they have a process, just like I told you. The truly great players in any endeavor, they focus more on the process of being successful and less on the goals of being, the outcome itself. And so you need to understand, are you approaching the markets with all of the stuff? Do you have a complete trading process? Are you having the specific, do you an awareness of the specificities that you should be aware of, so you can start having healthier conversations with yourself in your own mind about your trading? That's a struggle that a lot of people have. And a lot of people in my experience still have. It's a behavioral change. I had a friend of mine once who was obesely overweight. He about 6'1", weighed over 400 pounds. Big guy, had played football in high school, but just over the years had just gotten bigger and bigger and bigger. And he tried a lot of different diets, and each new diet was kind of like, one of it was the trunk, and the next one was the tail, and the next one was this, that, and the other. He tried a lot of different things, but many of those things failed. Why did they fail? They failed because, he told me, he never made the lifestyle change he needed to make. He needed to start to think differently about his weight and about health and about exercise and about all the stuff. And if any diet that he tried was just a Band-Aid until he learned to think about it, feel, respond differently. And that's what we're all about. We're here to help you learn how to respond differently, to make better choices in the marketplace, to be less emotionally wrung out at the end of a trading day, and to be more healthy in your conversations with yourself about your trading, which will allow you to be more aware, right? You're not going to be blinding yourself because of fear. You're going to be more aware of opportunity and less likely to make bad mistakes and lose a lot of money. Now, I know we went through a lot of this fairly quickly. If some of you are interested in knowing more, you can call the number there, 888-806-1960, or just go to www.myconsistentprofits.com/eagle. And unfortunately, you still have to use the myconsistentprofits.com. So make sure you add that in there. It doesn't matter if you're brand new.
And also, Lincoln, we have that on the screen right now. So if you look in the chat box, you can click over right to that URL. It's in the chat box, and it's also pinned on the top of the chat box as well.
Oh, great.
And that goes straight to the page. So you can do that right now and fill it out and Lincoln tell them about, what they'll, the free consultation that you're going to give, that you said you'll give the Eagle people.
Yeah, that's right. So, Roger's a great friend, like I've said. And we want people to have an understanding. What we do is so unique and so different. We feel it's important that we go through this with you one-on-one. So we'll take you through the assessment. We'll walk you through that. We'll walk you through what that means and some of the strategies that will work best for you. And then we'll just talk about your unique situation and figure out what it is that you could maybe make improvements on right now to get more consistency. It's all about consistency, right? If you could depend on a consistent annualized rate of return, so many more things become easier. And you can only do that if you have a specific mechanism, right? This trading process that gives you clear expectations. It gives you rules derived from those expectations, and it gives you a feedback loop so that you can continually monitor progress and so that you can continually improve. I appreciate the time. Thank you, Roger, again for bringing me on. I have a mission, and Roger, thank you for letting me promote in some way that mission.
Yeah, well, thank you for joining us today, Lincoln. And, it's been a theme all day, has been education. And so I encourage everybody to, click the link and, sign up it's absolutely free session. Lincoln's given for everybody. It's one-on-one. And then if you want to learn more about it, great. If not, you'll learn a little bit in that 1 hour. So there's actually no risk and won't be, high, sales pressure or anything like that. It's just trying to help you out. And so I encourage you to click that link right now and sign up for Lincoln's free session. So again, Lincoln, thanks for joining us today. And everyone, we'll be back in just a couple minutes at the top of the hour with Bryan Perry. And if you have not subscribed to our YouTube channel yet, there's a button right below this video. So subscribe to that and make sure you get all our free content that will be given out at least weekly. And as I've been saying, we've got more and more big things planned for the YouTube channel. So lots of great free content to make you a better investor. So we'll see everybody in just a couple minutes. Well, hello, everyone, and welcome back. Hope you've been enjoying all the presentations we've had today. We're about halfway through now. Got a few more to go. It's been a very, very exciting day, and I hope you've learned a lot and are taking advantage of our specials and have signed up for our YouTube channel by hitting that subscribe button right below the video right there on your screen. So up next is Bryan Perry, the editor of Quick Income Trader, and a bunch of other services with us. And I'll turn it over to Bryan. Bryan, thanks for joining us today.
Okay, thanks, Roger, and welcome everybody to this particular section of the virtual larger presentation here for Eagle Publishing. And today I want to get into generating premium, big profits from all the market volatility. And Lord knows we've got more volatility this year than at any time in recent memory. And so there's a lot of ways that you can either get hurt by the volatility, or you can actually take advantage of the volatility. And this particular service here, Quick Income Trader, it thrives on volatility. And this is kind of why I thought it'd be a really good place for us to have this dialogue and have me introduce you to this particular service, which involves selling volatility back to the market. And Quick Income Trader it's a stock service that also sells covered call options for income, and it also employs the use of what are called naked puts for selling volatility back to the market as well. Both strategies are designed to generate extremely good income from these particular moves in the market. And so the more the market is volatile, the wider the options premiums become. So volatility is your friend in this particular type of environment versus working against you. And this is what I thought was something that everybody can really use, especially now where interest rates are on the rise, and being in fixed income isn't working because your principal's losing value as rates go higher. A lot of dividend stocks are just not, they're in the wrong sectors, and they're paying dividends, but their prices are going down. But if you can be in the right stocks, in the right sectors of the market, and I outlined a few of those here early on in the opening panel, then you can sell out of the money call options, and you can sell right at the money and naked put options and generate incredible income, as you'll see from our track record that we've been able to generate here just this year alone. So there's always something to do. There's a bull market somewhere, and the bull market in this particular market is in volatility. And it's just a matter of grabbing that volatility and bringing it into your account and not having to buy volatility, but we sell volatility. So let's get into that and see what that means. Market volatility, it's right back up to historic levels here. Last time we saw this was back in March of 2020 at the height of the COVID-19 crisis here. Before that, we saw that in 2018 during the taper tantrum. And now we've got, Congress and the Fed running counter to each other. You've got Congress spending very heavily, on this Inflation Reduction Act bill, which has now, become, $700 to $800 billion in new fresh spending, possibly as high as $1 trillion. And you've also got the Fed raising interest rates and trying to reduce their balance sheet at the same time. So you've got these two countervailing forces at work. And the spending in Congress, although well intended for their purposes, it gets a lot of attention because it targets a lot of big industries, but it really just continues to fuel inflation. And at the same time, we got the Fed trying to take money out of the system here via what is called quantitative tightening, where they're selling down $95 billion in treasuries and mortgages every month back to the market. So that puts pressure on interest rates as well. So you've got these, heavy spending, which is generating inflation, and you've got the Fed also trying to reduce their balance sheet, and they're selling into the bid of the treasury market. So both those forces are causing interest rates to rise. So it makes it tough to make money in bonds, in fixed income, and other types of what we call bond equivalents. The war in the Ukraine is dragging on. It's keeping a strong bid under energy costs, and then certainly Europe. It looks like they're going to be going through a very tough winter here, and inflation around the world and commodity prices is causing that. Plus, also, that's my bottom note here: the strong dollar makes it very difficult on other countries to pay back debt because most of their debt is denominated in dollars, especially those in emerging markets. So this makes for, a very, what I would call a narrow market environment where there's plenty to do if you're in the right space and in the right strategy. But normal, 60-40 investing, that's still popular in some places, but it's not working at the moment because the bond market's not in your favor. And for that matter, a lot of growth stocks are going through multiple contraction here. So we have to be in those areas where inflation is a tailwind and there's a lot of institutional involvement and there's a lot of institutional money flow, because we want to be where the money's flowing and we want to be in those sectors that are still inflation friendly as opposed to being hurt by inflation. So that's what drives us into making sure we have our money dedicated toward those trades, if you will, that are in these sectors, and keeping your stable of trades, pretty tight, between 5 and 10 trades, and not having, too much on board here. You want to stay highly focused in this market right now. So now we're seeing the Dow, seeing huge point swings, like yesterday up 550 points. Today we're down 600 points. And this is just, a lot of people don't know what to do with this because, there's obviously potential for black swan events out there that people are looking for. An event like we saw 2 days ago, where you had a disruption in the European bond market, where the Bank of England had come in and intervene, and they stopped their quantitative tightening and immediately jumped back to quantitative easing, where they had to go in and buy the 30-year bonds, the gilts, is what they're called, to support that bond market, where interest rates jumped from like 4.3 to 5% in just under an hour. And that would caused a lot of turmoil. The pensions were not happy with that type of price action. So they pressured the BOE, the Bank of England, to go in and support that bond market. And that's, you'd expect this black swan event maybe out of Greece or, Turkey or something like that. But when it happens in England, that's a big deal. We've also got Putin. He's annexing 4 parts of the Ukraine, and already using these thermobaric non-nuclear weapons on certain regions there. So even though Ukraine's made some big inroads, Putin's getting pushed into a corner. A lot of people are disappearing, in his inner circle, and there's a lot of pressure on him to either get to the negotiation table, but he's also, who knows who blew up the Nord Stream pipeline? All the accusations are going in his direction right now, but it could have been any number of possibilities. China's a big problem here too. The whole issue about President Biden promising to send troops to Taiwan if China invades is that's a possible black swan event. Iran deal triggers, if that goes together here, which the administration is really trying to bring that deal back to the table, it brings in, the threat of Israel basically saying, not on our watch. And then again, a large scale credit default event. China has a whole shadow banking industry that's worth hundreds of billions of dollars. And Europe is also a number one concern. When surveyed by fund managers around the world, where, what their number one concern is. And we saw just a blip of that, 2 days ago with the European bond market. There would be another larger, more systemic credit event. So these are all out there. And this is why we have to stay, really on top of the news, as well as understanding that the larger stock market, which is about $75 trillion large around the world, the global market, it doesn't really care about most of these types of geopolitical events. The news cares because it sells news and keeps eyeballs on the TV, but the market generally cares about 2 things: revenue and earnings growth, most of all. There's always, again, the money washes around. It doesn't all come out of the market. In fact, most fund managers are still fairly well invested. Like they say they have the highest level of cash on hand at this point in time, but that's only roughly 6%, 7% of total funds invested. So in general, fund managers are 95% invested around the world, 95% of the time, and are, so again, money washes and goes back and forth in certain sectors. And we just want to make sure that we're in those areas where they feel best and most insulated, and where they find the good risk reward of opportunity versus what's going on, around the world in terms of being in front of these trends and not having to chase these trends. And that's my job to figure that out. So there's 2 ways, and most of it's interesting because when I go to the money shows or talk to other people about, covered calls and naked puts, about 50% of the people don't have a really clear understanding of what's going on with the business of selling covered calls and selling, and especially selling naked puts. But as wonderful as selling covered calls are on stocks and ETFs, like we're going to do here, the bigger money is in selling naked puts, and we'll get that in the second part of my presentation here. And again, it's not really hard to understand here. These are both super easy to put to work in your account and put on most any listed security. Get paid right away in both assets, and then at the same time with selling covered calls, it's a transaction that takes place in any kind of an account. And for selling the call itself, that's a riskless transaction. You can't lose on that. The only thing you can really lose on is if the underlying stock goes lower and you collect 100% of the call premium, or the underlying stock trades above the strike price at which you sell your call at, and you end up having to sell the stock at a profit, but you still keep 100% of the call premium. So this is why a lot of institutional managers, they use this strategy here on a daily basis, because it enhances income and it also, hedges against downside risk. The general concept of selling covered calls, and let's use a $50,000 sample portfolio at work here. Okay, we can, if executed properly, we can generate roughly 4% a month just on selling covered calls against this portfolio, roughly $2,000. Okay, so $2,000, a month, times 12, okay, is, we're talking 24,000 a year in a decent market. It doesn't have to be a raging bull market, but just a decent market. We can generate 40 to 50% in income. Now, if we just pull those trades out and say go out every 30 to 45 days, we can still generate 25 to 35% in just covered call income. And that's a beautiful thing. Now, in this market right now, where we've been bear market since January, we're still selling calls on rallies, and then we're still, and selling naked puts on dips. So we have to manage that. It has to be a very proactive portfolio. This is not a buy and hold market. Okay, this is a market you have to trade, and this is a trading service. So it's ideal for the kind of system that needs to be in place when you don't have the wind to your back in a broad market basis here. So what this is designed to do is create a recurring stream of income in both these two models where you're selling covered calls. And what I'll do is I'll normally buy the stock, and then I will put I'll put a trade to have you guys put in a limit order that's at above the current price of the stock. So the stock has to rally a little bit to trigger the sale of the call. And if in doing so, you've made a little bit of money in the stock, and you've also captured some premium, the combination of which can generate this 4 to 5% premium. And this is that's kind of the secret sauce to selling a good covered salt, because you don't want to lose the stock at the price you just sold the call at. You want to give the stock a chance to appreciate a bit, and then sell some. And then you're going to cap your upside when you sell a covered call. And most of you know that trade this service. So
let me just say one thing about that, Brian. I think because that's really important. A lot of people who do covered call strategies, they do it both at the exact same time.
Right.
The reason that you've been so successful and better than most covered call people out there is that's what you just called the secret sauce, waiting for that stock to go up a little bit before you actually sell the option. So I just wanted to reiterate how important that is, and it is a little different than a lot of other people out there, but it's definitely better.
Yeah, most of your covered call closed-end funds that you'll see, they sell what they call right at the money. If a stock's trading at 50, then they're selling the 50 call for next month. So there's no room for upside, but they're capturing that premium right away. My trades typically involve you got to buy the stock, and then you'll have a standing limit order in there. So you can go out for a cup of coffee, go play some golf, or go to the movies, or whatever you want to do. And that trade is still out there. And if the stock makes a big move in the middle of the day, for whatever reason, some headline comes out and it pops and it'll trigger the sale of the call, you've captured that premium on a price spike in the stock, in the underlying stock. And that's really where I think that this differentiates itself from just about everything else out there. I don't know any other service that really, uses that particular methodology effectively and tries to do it on a steady basis, where we're really trying to capture premium inside every 2 months here. And so we want to be able to, and we also want to be in the same stocks if we can, and do this again and again and again. It's really good to get to know the stocks you trade intimately well. And, you know, you don't want to go from lily pad to lily pad in this business. You want to stay with the stocks that you get to know well. They have a pulse. They tend to be the stock du jour, if you will, of the sector, whether it's the electric vehicle sector or the hospitality sector or the liquefied natural gas sector. You know, I've identified certain names that I see that the trading community, the professional trading community wants to trade. And they tend to have a lot more vol to them, a lot more volatility to them, which I want, because the premiums expand, you know, higher and lower. And so we can capture more premium that way by being in those stocks that the professional trading community wants to be involved the most, and not trying to play second and third tier names. I want to play the names that the big money is trading actively for their own accounts. So as we move on, the word options is typically associated with a degree of risk, and that's true if you're buying puts and call options. This statement couldn't be more true, because 90% of all puts and calls expire worthless. Most people, they're just too greedy. What they want to do is they're buying a call option that's out of the money. Say they're buying a stock at, you know, the stock's trading at 50, and they're buying a call, you know, that with a strike price of say $55 that expires third week of October, only 3 weeks from now. Well, that's a dangerous trade, because, you know, in this market right now, for a stock to, and say they're paying, it's in a good name. Let's say it could be, you know, in a $50 stock there. Well, even a bigger name. Let's use Microsoft. Okay, trading at roughly currently around 236. Okay, and they're buying say a 250 call. You know, 14 points out of the money, but they still got to pay roughly $3 to $4 per contract. And so that's, you know, you've only got 3 weeks for that trade to work, and the stock has to go to at least 253 to break even on that trade, because strike price is 250. You pay $3 for the call, and if the market continues to trade in this range and not cooperate, then that's probably money down the drain. And this was why a lot of people, they don't buy enough time, and they buy too far out of the money. And this is why the greed takes over. You know, the market's made up of two forces: greed and fear. And when you can control Microsoft, you know, 100 shares of Microsoft, you know, is $23,600. Well, you can control 100 shares for $300 or $400 for the next 3 weeks. That's pretty enticing, but everything's got to go just right. And this is why a lot of people, and the same thing, people think that something's going to fall apart, and they buy a put for this, you know, short-term put, out of the money put, because they think that, you know, the market's going to continue to get slammed. Then, you know, that too, that works against you, because if you're going to be in the business of buying puts and calls, then you really should buy 3 times as much time as you think that trade is going to work out. And don't go so far out of the money. Buy fewer contracts, stay close to where the stock is trading, so that, and sometimes I even use in the money. If I'm going to buy puts and calls, I go in the money. So that's a whole different game, because again, there's a lot of risk, because options are time wasting asset. Your worst enemy in buying puts and calls is time. So make it, if you're going to be on the long side of buying puts and calls, then make sure you buy a lot of time, so that you can sleep well and know that if initially the trade goes against you, you've got plenty of time for that trade to still work out. And I use that in another one of our services, which we'll do some other time. So here's what happens here. There's two sides to every option trade. You have a buyer and a seller of risk. Okay. Selling covered calls is the business of selling risk back to the market. We know someone wants to you know, well, we use an example here. You know, every call option contract represents 100 shares of stock. So if we're buying 500 shares of stock and we want to sell some calls against it, we can sell 5 calls, knowing that if the stock appreciates and goes up and through our strike price, we could end up having to deliver those 500 shares of stock come following Monday morning. That's not a bad problem to have. It means you made really good money, especially if you're doing it my way. So selling call options against an underlying stock, you know, that's what it's called, a covered call, because the potential for the stock to go up has been covered by the underlying. You own the stock, so you know it's not like you got to go in the open market and buy the stock. It's not that would be a naked covered call. It's not a covered call; it'd just be a naked call sale. And so we want to own the stock, so we don't get caught up in the fact that, hey, a stock gets bought out on Monday or over the weekend, and the stock gaps up 20 points, and you're naked to call. Meaning you've sold the call, but you don't own the stock underneath. And now you got to go in the open market and say you sold the call for $5, but the stock's up $20. you never want to have that situation on your hands. You just want to always own the stock when you sell a covered call. In the event of a takeover, that happens to people, and they just, you're upside down by 15 points, and then you got to go buy the stock in the open market because you're getting called out. The simplicity of a covered call trade, and I'm going to use one trade that we've got on. We've been in and out of Rivian, which is it's in the right sector, which is the electric vehicle truck market, which is much more concentrated than the electric vehicle car market. Just got recommended today by Truist. They believe they've got a $60 price target on it. The stock's trading roughly around about 32. It's down from where I put this slide together. But we've had good success trading Rivian, and it came out super hot. Came out well above $100 and came back down to a reasonable valuation where now they've got a big deal with Amazon. They're for their last mile vans. They just cut a big deal with Mercedes-Benz for also their delivery vans and their service vans. So I like the story. It trades like water, millions of shares a day. It has a lot of institutional darling funds that want to be in this name. And so we can buy the stock in the mid. It's built a long base in here. Technically speaking, it's got a great base on the stock. You're trading between 34 and 40. So you've got a nice range in here. So if we can buy it on pullbacks and then, and then look for the stock to appreciate and sell the call, that's what we're trying to do here. So if we're buying the stock at 36 and we put in a limit order to sell the covered call at 40 with a $40 strike price that expires in a couple of months, in this case, November, then we're looking for if we get called out of the position, we can sell the call for $3 a contract, and we have potential upside in the stock, and we also have a really nice premium that we can bring in. So here's what happens. If we get called away, say the stock closes above 40 on November 18th, we're going to go ahead and we're going to get called away, and we're going to basically end up with a very nice profit. We're going to keep the $3 in call premium we sold, and we're going to make another $4 in capital appreciation for a $7 profit. Divided by 36, I think I've done the math on the next slide here. Let's see here. Oh, here we go. Here we go. Okay, so if the call option expires, then we're going to be called away, and we're also going to collect 100% of the $3 call option total profit. So we're going to make 19.4% on this trade if we get called away on November 18th. And here we are, at the very end of September here. So we're talking about 7 weeks. Think about that. If you can make 19.5% on your money every 7 weeks, and you roll that and you do the math over the course of the year, you're doing really well. Okay. And you're in a hot name right now. This is one of the hottest names in the market. And you're not paying up for it like when it was trading above 100. Now let's say what happens here if the market continues to trade in a foul mood and the stock closes below 40 on November 18th. So what's going to happen is we're going to keep 100% of that $3 call option here, okay, because we sold that and with the expectation that the stock may trade above 40. Well, if it doesn't, then we still get to keep the $3 contract, and say the stock is 38, okay, on November 18th. Well, we take our $3 divided by our cost basis of 36, and we still end up with an 8.3% gain. Not bad for a trade that's only, the stock has moved up 2 points and we're still making, it's moved up less than 5%, and we're still making an extra, 3.5%, 4% on the stock. And that's a nice way also to kind of, you can still generate really good income even if the stock doesn't go up through your strike price. Now, what happens here if the stock doesn't cooperate and it looks like, the stock's going to remain in your account and the fundamentals and the technical features are still pretty good, but then, the stock, say it starts to decline on you. Okay, well, you've got a break even proposition here. We bought the stock at 36 and we sold the calls at 3. So what happens is you can basically reduce the amount of the cost basis by $3, and that brings you down to $33, which would be your break-even point. That means collected the $3, the stock comes down to 33, and you can basically close out the call out. You can always buy your calls back at a fraction of the cost of what you paid for if the stock is down. But you kind of know where your break even is. It's your cost basis of 36 minus the premium that you sold it for. And that's kind of your threshold where you say, okay, I kind of want to exit this trade because it's not moving for me. And this is especially true if the market is in a good place. In a down market, a stock that's trading laterally or higher is it's very bullish. But in a market where you have broadly lower lower lows in place and the stock is kind of trading with the broad market and you've had a chance to sell calls against it, then exercise some discipline and use that break even point as a place to maybe exit and move on. Because we always know this is a trade. This is not a long-term investment. And again, we want to be using the same stocks over and over again because you get to know them really well. You get to understand their behavior. You get to see how they trade, and you get to understand how the options trade against the underlying stock. And this is, again, it requires very little time to manage. I'm talking about 10 minutes a month. I do all the work. I put out the trades. I give you the limit orders and the prices of which to do that. If something happens in the midst of a trade that we have to act on, then I send out an alert. Either close the trade out or lower or change the option price, whatever it might be. That's my job, is to monitor this. And really, it's just a matter of you're going to get these texts, or an email that's telling you what to do. And I'm not trying to make this a day trading service. This is not what this is about. This is about trying to do things on a weekly and bi-monthly or monthly basis. These are swing trades, as we call them. They're directional trades. You hope you can keep them inside a month, 2 weeks to a month, and that's ideal, for this kind of a service. But usually they end up being about, in this market here, a difficult market, somewhere between 30 and 40 days. But if we can generate these 15 and 20% returns over the course of, a month to a month and a half, we've done our job, because at the end of the year, you're going to be looking very good. So all we try to do here is you enter the symbol in the options chain, and you look at the chain, and you'll see where the most active issues are trading, most active strikes. And we want to, specifically get acquainted with the options that are associated with the stock. And that way you'll kind of get in my head as to why I'm doing what I'm doing here. This takes two to tango in this service. If you just follow the instructions and don't understand why you're doing what you're doing, then you can get scared out of a trade because the market goes against you. It's really important that you do, your end too, on your due diligence in terms of, I got to understand what Bryan's doing on his end so that I can appreciate why he bought the stock here and why he sold it, why he wants to sell the call there. And this is way that really helps. You're able to understand the trade better, because it's, again, we live in a very vibrant market where not everything goes right, in the first hour of trading after you get into a trade. But you can see the technicals, and I put in the charts in the service every day, every week. So you can see why I'm looking at things from a technical standpoint, which is very much just as important as a fundamental standpoint. And so, technicals matter, charts matter. The market is owned and operated by the high frequency trading shops out there, or the algorithms that really trade off these technical lines. So when something happens, the stock's sprint higher, but when something breaches a key support level, then they tend to trade down very quickly. So we have to respect the technicals very much, and you'll notice that in the option chains in terms of where they believe the risk is, in terms of, because options will price about as much a range in a stock, and that's called the delta, that's established by those that trade the options professionally. And that's something that, we all learn over time. I've just been doing this for 36 years, and I've got a pretty good understanding of how it works.
About 10 minutes, Bryan.
Okay. All right. So this, again, it requires very little time. The number of portfolios is going to run between 5 and 7 positions, depending on the underlying stocks. I hope that most people can use somewhere between $25,000 and $50,000 to manage this portfolio. It's a favorable strategy for retirement accounts. It's considered a lowest trade. This is the kind of option strategy that it's level 1 approved for any kind of an account at any given brokerage firm will allow you to execute covered calls. Okay, and then it's a great place to start if you have no experience in trading with options whatsoever. All your option premium is taxed as ordinary income, and it just makes sense to do this if you can, in in a retirement account, for short-term gains. But if you really depend on the income, it's a great way just to generate wonderful income stream. Okay, and so I'm going to jump forward here because I've talked about choosing the right stocks and the secret sauce, and with using institutional darlings that are the favorite stocks to trade. Selling naked puts. Okay, let's spend the last part of this session here on selling naked puts, because this is where you can really make some solid money here. And it's a very effective way that institutional money managers love to trade. Even Warren Buffett uses naked puts just to bring us into the fold here. It involves, what you're doing is you don't own the stock, but you're giving someone the right to buy the stock, to sell you the stock, not to buy the stock, but to sell you the stock. So if you're selling the Microsoft 225 puts and the stock is trading at 235, then you have you can basically say, I'm willing to own the stock at 225 if it gets down there, but you might take in $10 worth of premium and to sell someone that right. So you get paid right away. A naked put doesn't mean it's covered, and it's not. It just means you've opened yourself up. You have to have buying power in your account, or you have to have cash or buying power in order to execute this trade, because what you're saying is, I'm willing to own the stock if it comes down to underneath my strike price. But you're getting paid because you think the stock is at a point where it's just going to trade higher. So part of my job is to execute this trade when I think the stock is pulled back to a key support level, to sell the naked put right there. And in doing so, we capture and we bring in a lot of premium. And then as the market moves higher, as the stock moves higher, that premium shrinks. And because an option is made up of two types of premium: time premium and intrinsic value. Time value, intrinsic value. This is a time-wasting asset. So when you're selling puts, that person has bought that put from you because they think the stock is going lower. You're selling them the put because you think the stock is going higher. It's a bullish trade, okay, with 100% maximum potential for you can't make more than 100%, which is not a bad thing. It's a great thing. But when you sell a naked put at, say, $5 per contract, the most that you can make on that is $5, because the put shrinks in value if the stock goes higher. And if the put if it stays above the strike price into expiration day, you can bring home 100% on your money. Again, it requires cash or margin in your taxable account in which to generate this trade. So it's one that people should get to know better before you put it on. And here we use the Rivian example again here. Trading at the November 35 puts, which we've got on board right now. The October's right now. I'm using a November example, but you can sell those puts for November, the 35 puts at $4 a contract. The stock closes above 35. You're going to keep 100% of that $4 put premium, okay? Because you've given someone the right to sell the stock at $4, and the stock closes above that, you keep 100%. So again, it's a premier time-wasting asset when selling naked puts. And here's the best thing about it. Even if Rivian, say the stock, is trading around 35 and you're able to sell the puts at 4, if this time around November 18th comes around and the stock is still trading at 35, you're still going to keep 100% of the $4. This is the most beautiful trade I can think of, when a stock doesn't have to go anywhere and you get to keep 100% of the put premium or the option premium. That's why professional money does this trade all the time, because they put time on their side instead of against them. And this is the whole concept of time wasting asset profit management. And so again, we want to be able to, it's a bullish trade. When you sell a put, it's when you think the stock has bottomed out or is going to trade higher from there. You can always be put the stock, meaning the sign. So if a stock trades, like if this stock trades, Rivian trades below 35 and you took the $4 in, okay, but you say, what, I really don't mind owning the stock. You can always, and you've got the buying power, you can take the stock in your account and look for the stock to trade higher in the week or two ahead and then sell it out at that price also. We've done that many times. So it's always advised, to book profits on naked puts on any kind of price spikes, because that's usually that's how we capture these 20, 30, 40% profits. And we do that on a very steady basis. Now, I rarely do I wait around for the put to recognize 100% profit, because a lot of times when you get a price spike, it happens in just a matter of days, and you just want to capture that when you can. So the model's, it's designed to generate 20 to 40% returns per trade, and we've been able to do that with this particular service. Again, the hourglass says it all. We want to be, we want to be using this concept of letting time work on our side, and time wasting, meaning time running out for the other side of that trade. That's the greedy trade. We want to sell that greed back to them and give them no time for that trade to work out. So in conclusion here, it's a simple way to make money selling covered calls. Selling naked puts generates immediate income as the highest percentage strategy in the options universe, bar none. And it's easy to understand and get fully familiar with. Just walk before you run in this. When you start working with me, just have, start small, 1 or 2 contracts. There are people out there doing 10, 20, 30 contracts a pop because they made a lot of money at it. And this is one way you can really you can really turn this lemonade market into lemons market into lemonade. It affords the income investor a great way to generate money even in an up interest rate market right now. Very efficient for tax deferred accounts. And especially, this is when the premiums come in, when it's a volatile market here. So on a total return basis, we want to be able to generate 25 to 50% annually. And just as, to be able to say we've been doing it, we've been doing it. Okay, we've got some fantastic returns, especially in the naked put area. We're analyzing ridiculous returns of better than 300%. So with Roger, I know there's a special on this particular service here. Maybe you could help us.
Yeah. So, want to say, those returns Bryan just put up there, we've had this service for a number of years. I actually can't
5 years. Yeah.
5 years. And so this is not just, something we've done or just took a little bit. This includes all of this year. These are terrific returns. And I want to mention 2 things. We have a special offer. It's right in the chat box right now. You can click on the link there. It's 90 days for $90. It's normally $1,995 a year, but we have specials, as I've mentioned, all day today. Very special. We've never done $90 for 90 days ever before. So we've been doing it all day in all our trading services. And then it's just $275 a quarter after that, which is another good discounted rate. As everybody else is increasing prices, we wanted to decrease to get you in there and learn more and find better ways to make profits in this market. And this is a very steady way to get those consistent, as Bryan said, 20 to 40% gains. And we also, when you subscribe, you get a special report that walks you through exactly how to execute these trades. So, if it sounds complicated, it really isn't. We make it very easy when you get the trades, you get the trade alerts, but the special report helps you. And then we also have somebody, Grant, who can help walk you through these things. So click on the button on the chat box to, do your 90 days for $90 trial for a quick income trader. It's been a terrific. I mean, look at the numbers on the screen, just says it all. On our naked puts, we're averaging, 34.9% per trade, and we're doing that every 34 days. That's how we get to 375 a year. And
let me say one other thing, Roger, before we go. The stocks I'm incorporating they're not the $100 and $200 and $300 names. We're trying to use names that people can afford. So if you want to, a Rivian, for instance, $35. I'm trying to stay under $50 on these stocks, so that if you do want to do 2 contracts, your out of pocket risk is maybe $10,000 if you're put the stock or something to that effect. So we're trying to use stocks that most people can manage to have at least 100 shares, 200 shares, 500 shares of. And so that's kind of, that's important to note that. And again, when you start walking your way through this, especially with the naked puts, you'll have that aha moment when it all comes, oh, I got it,
Yeah.
And people come up to me and say, man, that is the best strategy I've ever, bar none, what I've ever done, put my money to work. And now I know why very wealthy people use naked puts. And so give it a try. Again, walk before you run, but I think you'll find it to be a really exciting service, especially when I'm there to help you walk you through these trades and get it right. You know,
Yeah.
through-
Yeah, Brian tells you exactly when to get in, exactly when to get out, and exactly what to do. So, like you said, it only takes a few minutes every week and you're good to go. So, Brian, thank you so much for joining us today. And want to remind everybody to hit that subscribe button below the video to subscribe to our YouTube channel. Click the link in the chat box to sign up for Quick Income Trader at that 90 days for $90 special offer. And we will have Mark Skousen will be coming up next in just a couple minutes. So stay tuned, and Mark will be here in just in about 5 minutes.
Thanks, everyone.
Hello, everyone, and I'm here with Mark Skousen, and I know we're on this live event, but this is being pre-recorded because Mark is in Florida right now, and of course we have the hurricane coming through, and we didn't want to risk him not having electricity and missing this event. So, Mark, thanks for doing this the night before. We really appreciate it.
Thank you. I just flew in from California, where I spend half the year, and here I am now in Florida, my other home. And arriving is so funny, the plane arriving just as everyone should be leaving Orlando because of the hurricane. It looks like it's pretty severe, so we could lose electric power and the internet. It's actually very windy and rainy right now, but so far the internet is working, and you can see me and hear Roger and I. So I wanted to be a part of this very important event. So I'm sorry it's pre-recorded, but I don't think it's going to make that much difference between what the market did today, which is up, unusual, up for a bear market, and tomorrow. So Roger, let's talk about my best strategy to make money.
All right, well, let me share my screen here and bring this up. So everybody should be able to see my screen. And so, Mark, I'll let you take it from here.
Well, thank you, and feel free to ask questions or make some comments yourself, since we've worked together now for what, 15 years or something. It's
19 years. Yep.
Yeah. And you're only 19 years old, so
yep. Maybe I started when I was 19, right?
Yeah, I see. So
yeah, right.
But here we are, 19 years later, and been very successful working together. You as my publisher, and my working with the investment newsletter, Forecasts and Strategies, and my various trading services. So among my various trading services, I do want to talk today about my most reliable technique to beat the market. I have a lot of different ways to make money. I have 4 trading services, and this is the most consistent winner. I mean, all of my trading services have done well, but this one's been the most consistently profitable. And so I want to talk more about that. But let me give you a little bit of my background. I've been writing my investment newsletter since the greatest president of the 20th century. For me, that was Ronald Reagan, was elected president in 1980. So I've been writing my newsletter coming up on 43 years. And of course, my goal is to write at least 50 years on Wall Street, write a book called 50 Years on Wall Street. So I'm going to keep going till 2030 or longer. So that's a opportunity to work together with you as subscribers. But over time, I mean, when I first started writing my newsletter, it was a monthly newsletter. It was printed. I didn't have a hotline at all, but now I have a hotline that I started in the late 90s. And that's every Monday. So we have both in terms of an e-letter as well as a voice message hotline. And then on top of that, I have 4 additional trading services that I have begun and found profitable short-term trading techniques with option trading, and gives you a lot of variety and stuff. So my forecasting strategy is kind of long-term. I don't make as many changes on my short-term trading services. So it's more for the long-term investor. I've always had one foot in the academic world. I love to teach. I've taught at Columbia Business School, Rollins College here in Winter Park, Florida, and now at Chapman University, where I am a presidential fellow and the first holder of the Doty-Spogli Endowed Chair of Free Enterprise. I'm very proud of that, because as an adjunct, it's pretty unusual for a person to get an endowed chair. So I'm really pleased with that. And that's at Chapman University. Steve Forbes in 2018 awarded me the Triple Crown in economics for my work in theory and my model for gross output as a way of measuring the economy and predicting where the economy is heading. And also for my work in history, the great economic thinkers in my book, The Making of Modern Economics. And finally, as a textbook, teaching economic logic as a textbook. So I was very pleased with that award. I've also been named the favorite professor. I received the favorite professor award at Chapman University. So pretty popular with the students, and it's just a great amount of joy to do that. I got started in this business actually working for the CIA in the 1970s, early 1970s, during the a financial crisis during that time period, a long-term bear market. Stocks and bonds did very poorly, and gold and silver and Swiss francs were the great investments, real estate, other inflation hedges. There's some differences between the 70s and now. Back then, the dollar was weak, gold and silver were rising. This time around, we have inflation, but the dollar is strong and gold and silver are weak. So it's a new era, that's for sure. Anyway, I worked for the CIA for a couple of years. It taught me about the financial crisis, the energy shortages during that time period, wage price controls. There's a lot of things going on in the 70s, but it's given me a great background because I've experienced all of these things, bull and bear markets, boom and bust in the economy, crashes and crises of various sorts, natural disasters, political turmoil, war, everything except nuclear war. Haven't experienced that, but Russia's threatening now with that. So there's always something new on the horizon. I've always felt an obligation to defend our freedoms and our rights, our constitutional rights. And so in the early 2000s, I started the conference Freedom Fest, an annual gathering of freedom lovers. We had 2,600 people. Roger, you've been to almost all of these, 2,600 people.
I missed the very first one I missed, but I've been to everyone. I've been to everyone since. So it's
Wow.
a wonderful, absolutely wonderful conference. I love it.
Yeah, and we're still growing. A lot of people, I've been talking to a lot of people in conferences that have really had a hard time, but Freedom Fest continues to grow because we really do talk about things that matter to people. This last year, turning the tide was our theme, and we certainly need to turn the tide, and I think the tide will turn in November to some extent. And look what's happening in Europe with two very strong-willed women now running the United Kingdom and Italy. So there are some things that are happening here that indicate that the tide is turning to more back to traditional values. And of course, I've been a big believer in writing books, and I'm sure many of you have read many of my books, such as The Making of Modern Economics, The Maxims of Wall Street is sold over 50,000 copies. Back in the day, I wrote a complete guide to financial privacy. That was my first bestseller, High Finance on a Low Budget. A Viennese Waltz Down Wall Street is very popular to use Austrian economics to make investment decisions. And I have a textbook, Economic Logic, so forth. So there's lots of different things that I've written in the subject of economics and finance. I have a PhD in economics. And so I'm an applied economist. I use the economic outlook. What is the Fed doing? It's really important to your investments. And for years, they fought recessions and adopted easy money. And that created a lot of artificial bubbles. We profited from those bubbles. We made money on the rise in the market. But now he's fighting inflation by raising interest rates. And the Fed is aggressively raising rates. And I think that's really making it more difficult to make money. So it's a difficult time period to be making money. But we've done a pretty good job in selecting. They say that, as they say on Wall Street, it's not a stock market, it's a market of stocks. So if you can pick individual stocks that have done really well, then that could be the way to go. So let's talk about the three main mistakes that individual investors make that professional traders do not. I mean, everybody makes mistakes, but we want to talk about the most important ones. Mistake number one in trying to guess when to get in and out of the market, that can create a real challenge, because everybody, of course, wants to get out at the top, buy at the bottom and get out at the top, but that's easier said than done. And there are some techniques that can be used to reduce your risk and increase your chances of making money. And we're going to talk about some of those short-term strategies. But the long-term trend is definitely upward, and investors should keep that in mind. Long-term investors can take advantage of these bear markets because we always seem to recover from them. Another mistake number two, is that most investors really don't understand their investments. They don't really take the time to study what's going on with the company that's publicly traded. They may not understand the macroeconomics behind what is going on. So you don't want to make that mistake. And finally, mistake number three, cash is safe, although you might want to think right now cash does seem to be safe when almost every stock seems to be under threat of declining in value. I actually have a 20% cash position right now because I want to look for bargain opportunities. So we've had to take profits on some of our positions, and especially in technology, a lot of these stocks have dropped 30% or more. So we've taken some profits in that area so we can build a cash position. What's the cash for? Is to take advantage of bargain opportunities, and we're getting very close to that right now. So it's a good time to be discussing this. So what is my, I guess the best strategy, my most successful technique for making money? It's really built on 5 pillars of profitability. So we really worked hard to find what these profits are. So let's talk about what there's about 6,000 stocks that trade on the markets these days. So there's plenty to choose from. Well, how can we narrow that down to really focus on stocks that really increase your chances of making money with very little risk? So I have 5 criteria, and our first one is growing sales. We want a company where sales are growing. So that's number one. Number 2 is not only sales going up, but we want to be profitable. So we want healthy profit margins. We would prefer profit margins of double digits. And so that, once again, narrows down a lot of companies. There's a lot of companies that have increasing sales but are losing money. So those are out. We're not looking for those. Third criteria is we don't want to chase a stock. You know how some stocks, especially the tech stocks, have gone up in value dramatically. Their PE ratios are over 100 or 200. And yes, they've gone up, but they're very risky because it all depends on the future if they can keep up the sales growth. So we're looking for something that may be overlooked by other investors. So we're looking for PE ratios that are relatively low. Our fourth criteria is we want a company that's growing, not only growing in terms of sales, but growing in terms of profits, earnings. So when the quarterly earnings report goes out, we want to see sales going up, and we want to see earnings rising at a more rapid pace than they were in the previous quarter. So once again, we're really limiting, we're cutting down the number of stocks that are out there for us to take advantage of. And the fifth one, I'm not going to be able to read that for some reason. Roger, what does that say?
It's the major institutional investing.
Oh, yes.
Insider buying. Yeah.
Kind of insider buying by institutions. Institutions need to own a lot of these shares, maybe even a majority of shares, because they know that when institutions buy, they're in for the long term. So that kind of insider buying is something we really think is really important. So we got these 5 criteria. Now let me give you something a little bit more specific that we look for, our 5 traits that every stock should have. So we have a screening process. So we have a computer generated screening process that goes through these 6,000 stocks that are publicly traded. And we look for exactly these 5 criteria. Okay, sales growth, I mentioned that before. We want to see sales growth, but by double digits. So they got to go 11% or more in the most recent quarter. And then our profit margins, we want to make sure the company's profitable. So we want double digit, 12% profit margins. That's important. Then we want a price ratios that's not too expensive. So if these are tech stocks, our PE ratio has to be under 29. And there are a bunch of them that are out there. But so we're not going to recommend Tesla or something like that in this kind of position. So we're going to miss out on some of these big winners over time. But believe me, when we can find undervalued, this is the way to determine undervalued stocks, is getting a low PE ratio. That's the kind of thing we're looking for. Now look at this. We want really fast earnings growth. This is the highest percentage of anything. We want earnings growth of over 23%. But boy, the first 3 will bring us down to 1,000 stocks. Earnings growth over 23%. We're going to be under 100 stocks out of the 6,000. That's how narrowly focused we can be. And then finally, we look and make sure there's major institutional buying. So when you look at all of these different criteria, each one reduces the number of qualified in stocks for us using our computer screening process. And we basically get down to 30 or 40 stocks. That's it out of the 6,000. So as we say here, we're down to the top 3.1% of all stocks. And at the most, I've seen 70 stocks. Right now, we have about 45, maybe 50 stocks in our portfolio. I've seen it when it got down to 20% because we were in such a major bull market that there were very few bargains left. And that was the situation in 2019. And then, of course, we all know what happened in 2020. In my newsletter is called Forecasts and Strategies, and I made some pretty good forecasts, including 2020, where I warned against a black swan event. Turned out to be the pandemic that caused this tremendous system that just kind of exploded on us. So here's what we do. We recommend individual stocks. We place a stop order so we can never lose more than 20%. And then we recommend for anyone who wants to be a little bit more speculative, out of the money call options to create double digit wins. Now, what do we mean by out of the money call? So if we recommend IBM and IBM is selling for $100 a share, then we might recommend options at $120. So you have the right to buy options at $120, IBM $120 a share. And if the stock goes above 120, you can make a lot of money. So let me just give you some examples, or I have a trading service that I really want to emphasize here for you. This is my best, most consistent profit winner. They're all profit winners, all 4 of them, but this one in particular has done really well. If you want to try my service, this is the one I'm recommending that you try, called the 5-star trading, and how does perform. So Roger, maybe you can go over some of these spectacular returns that we've had.
Okay, yeah. So we launched this in February of 2016, and we came up with those numbers. We did a lot of testing and a lot of Mark's knowledge and a lot of back testing to come up with all those criteria to really make sure we're getting the cream of the crop stocks. And it's done very well. So since February 2016, we've had 127 double-digit gains, 92 triple-digit gains. We even had a winner that was over 1,000%. And since 2016, our average annualized gain is 61.76%. So it's been done really well in both. It's obviously done better when the market's been up, but even in tough times, we're getting the cream of the crop, the best stocks, and we've been doing pretty well there. So let's go through.
I should mention that this year, where the market is down 20 or 30%, the majority of our trades have been profitable, and that's not something most trading services can promise.
Yep. So let's take a look at some of the winners. And as Mark mentioned, we have the stock and we have the option, and you can see how you can get such a much bigger gain on the option. Penn, Virginia, Mark recommended the stock, made 93%, but the option 421%. Go to another one, British American Tobacco, only 8% on the stock, you know, still not bad. We hold these stocks an average of about 2 months is the average holding period. So still 8% in 2 months is not bad on a stock. Option 159%. T Rowe Price, another good solid double-digit gain, 18% on the stock, 258% on the option. Scott's Miracle-Gro, 17% on the stock, 424% on the option. Here's a bunch more. I'm not going to go through all these, but you know, the 1,000% on H&E equipment, 953% on Valero Energy, 496% on GM. On a stock like GM, you can make 496% in a short term. Here's a few more. You can see where these ones aren't quite as good, but these are, you know, still 300 and 400%, 421% on Public Storage, 386% on Alibaba Group Holding. And as you look through these, Mark, you know, there's a, you know, they're in different sectors. They're all over the place because the screening process, again, it's not looking at particular sectors or anything like that. It's looking at the whole market and taking the best of the best. And as Mark mentioned in 2022, well, hey, we all know the market's been tough, but yet we've had 14 double-digit wins and 3 triple-digit wins during this tough market.
Makes up for a lot of you know, stocks that didn't do as well. So the overall portfolio has done really pretty amazing. That's why if you're going to be a part of this service, be sure to take a look at all of my recommendations. There's a tendency to cherry pick a lot of these types of things, but it's really hard to predict which ones will be big performers and which ones will just not work out for whatever reason.
Yeah, I would definitely recommend you put an equal amount into each one because yeah, you don't want to miss on the winners, because when the winners are big, they can be some big winners like we just talked about. So here's everything you'll receive if you join us for 5-Star Trader today. Mark, do you want to go through?
Yeah, sure. So I love doing this service. And by the way, you have to have some enthusiasm for this whole business, and every day is different. I'm constantly analyzing what stocks to take a look at, how we're doing, and monitoring the option strategy to make sure we make money. When we double our money, we sell half of our call options, and then we hold the rest for potential additional gains. So the figures you're seeing is actually the average over the period when we held that stock and the call option. So sometimes they can be more or less. So those are averages, and those averages look pretty good. So you get a weekly hotline, the newest and most exciting stock and options, full instructions on how to make each and every trade. So it's a very simple process, and only takes less than a couple of minutes for you to look at it, analyze it, and call your broker or go online simply to buy the stock in your portfolio and the out of the money call option. And then we occasionally have urgent action alerts, up to the minute urgent action. You won't miss out on a single cent of profit. So we're monitoring these events all the time. And when things turn around, this is especially opportunity after when a bear market takes place. This is giving us a bargain opportunity where we can get a stock that suddenly appears on our screening, because we do the screening process every month. And suddenly these new cheaper stocks appear because the PE ratios have come down. And boy, those are where the big profits are being made. And this is that time period when And the markets have been really have plunged, and new opportunities arise. You can see how fast the market can turn around. I believe the stock market does want to go higher. It's just that the Fed is fighting us all the way, and they have the upper hand. So you got to be very careful. But at some point, the Fed is going to panic, and the Fed is going to throw in the towel, and that's when interest rates are going to start going back down, and the market is going to roar ahead, and we are going to be there for that. So we apply an option to every one of our stock recommendations. So the conservative investor, they can just stay with the option and make a double-digit gain, for example, in a couple of months. Nothing to complain about there. And then I'd say about half of our subscribers love the call option strategy, the out of the money call options, which would allow you to double or triple your money, as we have seen.
Yeah, why don't you talk a little bit about how there's, there's pretty complicated option, strategies out there, but you keep it simple, and it, so tell us a little bit about like how simple it is.
Yeah, we found that if we have you can buy options, you can sell options, you can buy call options, you can sell call options, you can buy put options, sell put options, there are spreads, there's all kinds of different techniques that are really rather complex. We try to keep it very simple because we want investors to understand perfectly what we're doing. We're looking for a stock that we think will go up, and we think it will go up now at this time rather than waiting at another time period. Doesn't always work out, but most of the time it does. And so we keep it very simple with just the buying of call options. And what's cool about it is you can never lose more than 100%. There's never any leverage involved here. So you can be totally wiped out by your call option, but that means you lose only the money you put into it if it doesn't work out during the time period that we're looking at. The majority of our call options do make money, but it is a little bit higher risk, but not as bad. I mean, the out of money call options that you buy, you can never lose more than your investment, which is great. So it's not like buying on margin, stock on margin. It's not like buying a futures contract. The call options is the most exciting, best way to make money now because you're limiting your risk on the downside and you have unlimited profits on the upside. So that's how we
and you don't have to
that.
invest nearly as much. The call options, on $100 stock might only be, $5, $10. So
well, it's $5 per option. So that would be $500 to buy the call option because you're buying 100 shares worth. So, but it's a small amounts of money and you control a huge position. You control 100 shares. So we put in place certain limits so that we're always limiting our potential, any kind of loss on the downside. So on the stock itself, we put in a stop order to keep us from losing money if in the case the stock drops by more than 20%, we're out and we move on to something else. But what's interesting is that if the stock moves up 10%, that's when we start raising the trailing stop. So if we have a 50% gain in 2 months, we're going to raise our protective stop so that we will keep profiting on the upside. But let's suppose the market turns against us and we end up selling at a 40% gain. So these protective stop orders are really valuable in helping us from controlling our losses, limiting our losses. We say that let your profits run and let your and cut your losses short. That's a long-standing traditional view that I talk about in the maxims of Wall Street. And that's the kind of approach we use here. And it's really very effective. When something goes against us, we get out and we move on to something that's more profitable.
And then you also by raising that protective stock, you're locking in gains. So you don't have a gain turn into a loss, which is like, the worst thing in investing, right?
Yeah, that's my #1 rule. Never let a profit turn into a loss.
So we have a
So,
website
go ahead.
that covers, you know, everything. We have every recommendation, all the past alerts. We have special reports in there, so you can always stay up to date. The website's updated, so you can see the stock prices, so you can see the whole portfolio and see the prices move throughout the day and what our gains are. So, you know, everything's accessed at your fingertips.
Yeah, it is. And I believe when you subscribe, you can go back and look at my previous recommendations and my trading services that are sent out. So you have a really good track record. You can go back and take a look. So we're not hiding anything.
Right. Yeah.
and
Every
we've been very
alert you've
successful.
ever sent out is on there. So
Yep, that's really important. You know, people appreciate an honest approach, and we don't see enough of that in today's business.
Right.
So we also have conference calls. I think we do this every couple of months, right, Roger?
yeah, they're not exactly
Teleform?
planned, but we do probably around 5 a year.
Yeah, and it's just great because you get the chance to ask a question. We listen, we see all the emails that people send in. What are your concerns? And so we try to answer those questions on this teleconference that we do every couple of months. So it's a great opportunity for you to hear my latest updates, to answer your questions, and we have these poll questions are really a lot of fun. So we find out what people are thinking, what investors are thinking.
Yeah, every conference I go to, Freedom Fest, Money Show, whatever, everybody's always, oh, I love those telephone conferences. They're so great, and we really appreciate it. And yeah, they can talk to you directly and ask questions. So we love doing those. So we have a special offer today for 5-star trader. Everything we've been doing today, or we'll be doing, I'm taping this the day before, but all our trading services on the special live event that we're doing today is $90 for 90 days. A really, really good chance to give it a try for 3 months, see how it is. It's normally $1,995 a year, but you have this great introductory price, and then afterwards it's $275 a quarter. But we know it's been tough out there, and everybody's out there, inflation's high, everybody's been raising their prices. Well, we're going to do just the opposite and give you a good deal to get in, give it a try. And there's on your screen, you'll be seeing a link to order, and just click on that, and you can, just put in a couple of your information and sign up, and you'll be a member of 5-star trader and participate in all these great gains that we've been talking about. So again, click the link in the chat box and get our special 5-star screener special today, 90 days for only $90. And I'm gonna stop sharing my screen. And Mark, any final words for everybody?
Yeah, I tell you, it's been an exciting time period, and we just made a new recommendation of the, as most of you know, I'm not a big fan of the unions, but there's a union-controlled bank out of New York that is just making money hand over fist, and it came up on our screening process this last week. We're already in the money with this bank, and it's a bank stock, and you don't normally see it. But again, this screening process is so fascinating. It'll blow your mind to see what kind of stocks appear. It's very hard to predict what will appear, and it changes every month that we do this 5-star screening process. So we already have a winner, and it's just beginning to take off. So join us and get on board with that particular stock. I think that this is the kind of thing that makes investing exciting. Yes. So thank you all, and just remember, fellow free marketeers, AEIOU. Thank you, right, well, and talk to you soon.
Yes, well, thank you, Mark, for doing this with it was obviously going to be live, and then when the hurricane was looking like it's going to hit and everything, Mark is like, hey, we gotta tape this and make sure, that everybody, hears this. So we appreciate you doing that, and stay safe, and thanks again. We'll talk to you later, Mark.
Okay, thank you, Roger, and good luck, everybody.
Hello, everyone. We're back live. The Mark session, as you may know, depending on when you tuned in, was recorded last night because he's down in Florida and we weren't too sure whether he's going to have electricity. But I hope you enjoyed his session. And again, I want to remind you to, if you want to sign up for 5-Star Trader at the special 90 days for $90 price, click the link in the chat box right now to take advantage of that offer. And in about 10 minutes of the bottom of the hour, we will have Bob Carlson. He will be the one batting cleanup and be our last presenter today. And I'll remind everybody to hit that subscribe button to right below this video to subscribe to our channel. We just launched this YouTube channel about maybe 6 weeks ago, and we've gotten some great feedback on it. There's lots of great free information, and we have a lot more coming, and we have at least one new thing every week. So again, hit the subscribe button to subscribe to the YouTube channel. If you want to subscribe to 5-Star Trader, click the link in the chat box, and we will be back live with Bob Carlson at the bottom of the hour. Thanks. Well, welcome back, everybody. It's been a very exciting day, and we have Bob Carlson batting cleanup for us. Had lots of great sessions and looking forward to one more. I want to remind everybody to hit the subscribe button below this video to subscribe to our YouTube channel and get all the free information on free videos that we have there. Lots of great content and lots more to come, and we'll be updating that regularly, at least once a week, actually. So let me turn it over now. Bob, it's all yours.
Thank you, Roger. Thanks everyone for joining. So let's get right into how to spot turning points in the economy and markets. Now, if you don't want to be a buy and hold investor with at least part of your portfolio, then you want to be tactical. You want to move your assets around based on what's happening in the economy and the markets. And when you do that, it's important to have a process and a system that you developed over time. You don't want to be bouncing around based on the latest headlines or the latest hot trend or the emotions that are getting people caught up. So you want to have a systematic process, something you're going to follow regularly, even when it's not doing well, because any good system is going to have periods when it's out of sync with the markets and it's not doing well. You want to refine it over time, but you want a system that's going to continue to give you confidence and that you're going to follow. And one of the keys is it's not just good enough to anticipate what's going to happen in the economy or some part of the market. You have to anticipate what's going to happen before it's priced into the market. If everyone knows that something's going to happen, they've already bid up prices before it's happened, and you're not going to profit from it much. So you need to anticipate what's going to happen before it's priced into the markets. And if something's already reflected in the markets, then it's too late. You need to find another opportunity. So those are just kind of some of the basics about being a tactical investor. A number of systems work. You just kind of find the one you're comfortable with and that works for you. Now, when you go to looking at what's going to affect your investments, over any reasonable time, there's really just two factors: economic growth and inflation. Other factors will affect it, day to day or even week to week. But over any reasonable time, it's these two factors. And they can go in the same direction or they can go in different directions at any particular time. So you want to look at those two, and you want to focus on an extended trend, not an hourly or a day-to-day trend. And then you respond to your portfolio however these are moving. Now, since you're looking at economic growth and inflation, and these can be moving either in different directions or the same direction, either can be moving in one of two directions, up or down. So you put that together and you have the economic cycle. In the expansion phase, you have growth rising and inflation falling. In the peak phase, which is where we are now, a little past peak, you have still growth rising and also inflation rising. Then as the economy contracts, growth is falling, but inflation is still rising. Many people don't understand that, but typically, as the economy is contracting, inflation is still baked into the system and it's going to keep rising. And I'll discuss that a little more shortly. And then finally, you have the trough phase, the bottom, where both are falling. And so you want to look at your economic indicators and decide where you are in this cycle. And that'll tell you which assets to invest in. And because this is how the different assets perform in these different cycles. When growth is rising, obviously that's good for stocks and bonds and real estate and usually commodities. During much of the 2000s, commodities did not go up even though the economy was rising, but typically commodities rise when growth is rising. And that example is a good reason why it's important to be diversified, even when you're sure of which part of the cycle we're in. It doesn't always perform the same as all the times in the past, and commodities were a good example in the recent past. So you don't want to just put all your money on one asset class or one asset. You want to be diversified even within these pockets of growth and inflation. And then when growth is down, that's obviously bad for stocks and and real estate and commodities, but it can be good for other things. Bonds, treasury bonds, nominal bonds, also typically inflation index bonds do well when growth is falling. And the gold and the dollar usually do well in those times also. When inflation is going up, you have this basket of assets that typically do well during periods of rising inflation. And I'm going to discuss that in a little more detail shortly. And then when inflation is going down, typically the assets that do well in a rising growth environment also do well in a declining inflation environment. So those are the different parts of the cycle and the different assets that do well in these different parts of the cycle. Now we have inflation. It's kind of a puzzle for a lot of people because typically they think if inflation is rising, I should buy gold, and gold is the big inflation hedge. But if you look at data over history, there's really not any one asset that does consistently well during periods of rising inflation. There is a group of assets that often do well when inflation is rising. None of them does well every time inflation is rising. So your basket of inflation hedges are gold, commodities, real estate, or real estate investment trusts traded in the stock market, and then inflation index bonds, which in the US are TIPS, Treasury Inflation Protected Securities. Now, as you know, gold has not done well in 2021 and 2022, despite the rising inflation. And there are different reasons for that. But it's a good example of how none of these inflation hedges always does well in a rising inflation environment. So it's why you want a basket of inflation hedges rather than trying to put all your money in just one as your inflation protection. And in fact, I typically like a mutual fund that manages all four of these. It's the DWS REEF Real Assets Fund. REEF is spelled with 2 R's. And it has a number of share classes, but the main one is AAASX. That's the ticker. And this fund, as I said, it has all four of these real asset classes. And they manage it. They manage the allocation. They can change the weight that they put in each of these asset classes based on where the economic growth cycle is. And they also manage the individual components of these asset classes. They'll alter which commodities they own or which real estate investment trusts they own, things of that nature. So that's one way you can add an inflation hedge to your portfolio very simply anytime you expect to have a period of rising inflation. But the main point here is that there's never one consistently successful inflation hedge. You need to put together a basket of them so that you do well. In the recent inflation surge, commodities have done really well, but gold, real estate investment trusts, and even the TIPS have not done particularly well, largely because interest rates have been rising so much and also the dollar has been so strong. And the REITs have been kept down because they've been going down with the general stock market. But the mutual fund that manages all four of these, it's done pretty well. It's certainly beaten the stock market during this period, and it's given you some inflation protection. Now, you want to take this information. We have these 4 parts of the cycle, and we want to get to the heart of this, which is how we spot these turning points in the markets. And it's important to know that none of these indicators we're going to look at perfect. I've narrowed it down to ones that do work consistently well, and especially when you consider them together. And these are the ones I use when I'm making investment recommendations for Retirement Watch. And in my online seminar series, the Retirement Watch Spotlight series, every 6 months, every June and December, I review these in detail along with a few other indicators and give an assessment of where we are in the economic cycle and what assets are likely to do well going forward. And your focus here should be on looking for early warnings of recession. Because you really want to be out of your growth assets when it looks like the economy is going to be going down. Typically, most of the time, the economy is growing. It's good to have a fair amount of growth assets in your portfolio. But you want to avoid those big losses that occur in recessions and the period just before recessions, because the way to the highest long-term returns is to avoid those big losses in the bear market. So that's one of the things I'm going to focus on, is those early recession warning signals. Now, the first and most important factor is the Fed. The Fed typically determines what's going to happen with growth and inflation with its policies. Many people focus on interest rates, but interest rates are just one of the tools the Fed uses, and it's the most public tool, but it's not the most effective one, and it's not the one it uses the most, particularly in the years since the financial crisis. The main thing to look at is the Fed's balance sheet, which is also reflected in a statistic called the monetary base. This is easy to find. The St. Louis Federal Reserve Bank's website has a segment that's called FRED, the Federal Reserve Economic Database. All this data, it's free, it's downloadable. It's what I use most of the time to get my economic data. It's a good source for learning where these various factors are and using that to determine where the economy is. So the monetary base, you've heard the Fed, it's quantitative easing. It bought treasury bonds and mortgages and other assets and increased its balance sheet. And you can see that here. This is just the last 10 years, but you can see that in the years still after the financial crisis, the Fed was still adding to the balance sheet using quantitative easing to support the economy and the markets. And then it maintained its balance sheet, but didn't increase it for a period of time. In 2015, it tried to do what's called quantitative tightening by reducing its balance sheet. The markets and the economy did not respond well to that, so it quickly reversed course, stopped shrinking the balance sheet. And then it tried again in late 2018, shrink the balance sheet. Again, the markets and the economy slowed down very quickly. So the Fed reversed course and stabilized the balance sheet again. And then we had the pandemic period here on the right part of the graph where it just bought bonds and mortgages and other assets hand over fist and really boosted the balance sheet until recently when it's begun quantitative tightening again to try to reduce the inflation. So that's the overall monetary base. Another way to look at it is the 12-month rate of change. And this is kind of easier to see what's going on. And here you can see some of these changes I talked about and how the Fed responded and changed policies at different time. And if you recall how the economy and markets responded at different times, you can see how powerful this is and how much the Fed affected what was going on in the economy and the markets. So that's the first thing you want to look at is Fed policy. And that's everything is going to follow from that. So you should try to look at these data to know what the Fed is doing. I also mentioned that the Fed does use interest rates. It's its most public policy tool. It affects primarily short-term interest rates. Other factors are affect long-term interest rates, but the short-term rates are usually just in control of the Fed. And here's the 3-month Treasury yield. You can see how it went down to near zero during the pandemic and steadily climbed since late 2021. And it's now hitting highest levels it's had in years. And so this is another indication that the Fed is tightening, that we're moving from a period of peak economic growth with rising growth and rising inflation into a period when growth is going to decline and inflation will still be rising for a while before it takes hold. And that's one thing people need to understand is when the Fed changes policies, there's a lag period in how it affects different things. It initially affects the financial markets, stocks and bonds. And we saw that in 2022, as soon as the Fed started tightening, stocks and bonds lost value and they've continued to lose value. Later on, the economy starts to be affected, and we've seen that start to happen with some of the economically sensitive factors in the economy, sectors in the economy being affected. And inflation is the last to be affected by changes in Fed policy. And that's one thing where people frequently overlooked is they think tightening of monetary policy will affect inflation right away. The markets were confused by that this year because investors continued to bet that once the Fed tightened policy, inflation would come down right away, and then the Fed could stop tightening. But that was not the case. That's usually not the case. There's usually a 12 to 24-month lag before these changes in monetary policy affect inflation. So that's what the Fed action does. Now we want to look at how it affects some real economic activity. And these factors, these are the ones that historically have been the best early indicators that a recession might be imminent. Here we're looking at the consumption part of the economy, real retail sales. You look at the percentage change over the last 12 months in a rolling graph. Anytime this 12-month change is above zero, typically we're not near a recession. But when the 12-month change approaches or gets below zero, that's frequently a sign that a recession has begun or is about to begin. And so here on the right side, you can see that retail sales growth dropped pretty precipitously through most of 2021 and early 2022, but it's still positive. It's not as strongly positive as it was a couple of years ago, but it's still positive. It is starting to trend down. The 12-month change is slowly declining. So that's something to keep an eye on to determine whether or not we're on the verge of a recession. But for now, consumers are...
Quick question.
Yeah.
Question, Bob. So, you see those two really big, spike down and a spike up, which doesn't, over this chart seems pretty extreme. Does that happen very often? And
no, that's
why
unique.
why was that such a
That's just the pandemic. The big drop is the pandemic recession. And then the big spike up is after the stimulus programs began and the economy opened up a little bit and people started to spend more. And the spike up is distorted because you had a big drop and down to below zero and then suddenly a big surge up. So it distorts how much it increased. But yeah, the pandemic distorted that. It'd be easier to read if we didn't have those big spikes because it would all be in a much more narrower picture. But yeah, that's a good point. Very unusual. It's a historic move, as was the historic move in the stock indexes and GDP and some other factors. So that's the consumption part of the economy. Another part is the production or supply side. I look at industrial production. This is really one of the most reliable indicators we have of a recession might be coming. And here I've just taken a screenshot of the Fred website because these gray vertical bars show you recessions. And this goes back to the end of World War II. And you can see that almost every recession was preceded by the 12-month growth in industrial production going negative. So that's a very good indicator a recession is on the way, is when the 12-month growth in industrial production is falling and is at or near zero. The only exception to that, you can see towards the right side, is 2015. Industrial production did dip below zero, but that was very temporary. As I said earlier, that's when the Fed initially tried quantitative tightening. The economy and markets responded very negatively, very quickly. And so the Fed quickly reversed policy, so it avoided a recession. But other than that period, so far, anytime the 12-month change in industrial production has turned negative, that's been the first months or even the months preceding a recession. So that's a good indicator to be watching. Now, typically, the labor market is a lagging indicator of the economy. Often, unemployment does not start to get into uncomfortable levels until we're well into a recession. However, if you take the unemployment rate and compare it to its 12-month average, that's a good signal of when a recession is imminent. Here, the unemployment rate is the blue or darker line, and its moving average is the red line. Now, when the unemployment rate is higher than the moving average, that's a sign of a strong labor market. That shows that the unemployment rate is either steady or continuing to decline. However, when the red line, the moving average, is above the unemployment rate, that shows things have turned around, unemployment is rising, and it will be reflected much faster in this data than it will just in looking at the number of people who are unemployed and labor market data such as that. So this can be an early indicator that the labor market has turned, that more people are being laid off, and that we're heading toward a recession. Or you can simply look at the trend of the unemployment rate, the dark line. When it's going up, that's early in a recession. When it's going down, then we're in a recovery period. So this is another good sign that a recession is imminent. It's been a very reliable early indicator of recessions and downturns in growth. Now, inflation, there's not a real good data point that gives you an early warning about that. But what you do is you look at the Fed policy, as I discussed earlier. There's a lag between when these changes in the monetary base and interest rate affect inflation, but it does happen when the Fed changes its policy. Typically 12 to 24 months later, there's a change in the inflation trend. Now, for the last 20 years or so, that's not been as reliable because basically we've been in a kind of a deflation, disinflationary period, and that's because there have been a lot of big picture trends that reinforced the disinflation that kept a lid on inflation. There was the high debt levels in the developed world that helped trigger the financial crisis, globalization and competition, low wages throughout the world, pro-business policies in many governments, things of that nature. These all together kept inflation below long-term trends and allowed the Fed to inflate the monetary policy as much as it wanted to in order to combat a recession without any fear of raising inflation. Also, during that period, productivity was steadily increasing at a very rapid rate. Now, all or most of those trends have reversed course or frozen. We're not having as much free trade and globalization. There's more international conflict. Labor is much more powerful than it was, and I'll show you some data on that shortly, but this period of steadily low wages that increased at less than the inflation rate appears to be over. Governments around the world are less pro-business than they were. They're getting more aggressive with antitrust enforcement, with business taxes and things of that nature. And also productivity has really declined the last few years. So these secular deflationary trends are ending, and we're getting back to a period where when you want to anticipate what's going to happen with inflation, you can pretty much just look at what the Fed's doing. And then if it continues to do that, sometime in the future, the inflation trend will change. But another key factor is wage growth. And that's because prices can't go up if people don't have the money to pay the higher prices. So you want to look at your average hourly earnings increase over 12 months. And here we can see that before the pandemic, the wage rate was starting to rise for a long time. We're locked in a period when average wage increases were 2 to 3%, very modest historic wage increases. It allowed businesses to expand their profit margins and cut prices, things of that nature, but it started to increase even before the pandemic as the Fed's quantitative easing following the financial crisis really built up in the system. And also as we had fewer and fewer workers to fill the available jobs. And then since the pandemic, the 12-month increase in wages has really gone up. It's still below the inflation rate. So on a net basis, people are earning less, but these wage increases are higher than they'd been previously. And as long as these wage increases are in place, we're going to have a higher level of inflation. Businesses are going to have to pay more for workers. You're all aware that we have more job openings than we have unemployed people. and that the biggest problem many businesses report is having enough qualified workers to fill the jobs they have. So inflation is going to remain above the Fed's 2% target for as long as these wage increases are in place. And that's why if the Fed really is serious about getting down to its inflation target, it's going to have to tighten monetary policy enough to cause a serious recession that will hamper demand and cause a lot of unemployment. But the average hourly earnings 12-month wage increase is a key indicator of what changes are going to be coming in inflation and consumer prices. So how to use this data? Now, as I said earlier, most of the time the economy is growing, the stock market's going up, and you want to be invested primarily for growth. So you want to use this data for two things. One is it time to add some inflation hedges to your portfolio? And the other is when might the economy be slowing, which will slow earnings and bring down growth. And during those periods post-peak, that's when you want to consider eliminating your growth assets, perhaps adding long-term bonds, although that would not have worked out in this latest cycle. But typically, at some point late in the growth cycle, adding long-term bonds to a portfolio works well. And then when the Fed is, again, easing monetary policy, when it looks like recession is ending, growth is about to resume, then you can increase your growth assets. So that's really how you want to use this data is you have your long-term portfolio, which is going to be primarily growth oriented for most of you. And then look for those periods when the inflation might be rising more than the markets expect, or when economic growth might be slowing and a recession might be on the way, and then you want to throttle back your risk. And here again is the market cycle is a little different depiction of it, but my assessment based on these factors is that we're past peak. We've already seen parts of the economy start to slow. Housing is the most sensitive, and if you've been following the headlines at all, you've seen pretty serious change in housing just in the last few months, that the very hot housing markets of the last couple of years have cooled very quickly. Houses are starting to linger on the market. Prices are coming down. Interest rates on mortgages are way up over 6% now. So that's the most inflation or interest rate sensitive. It's the most sensitive to growth. And then we're starting to see that spread to other sectors of the economy. Now, right now, it's not a general economic decline. That's because the consumers still have a lot of savings from the pandemic period. And also we have high employment, and we have these steady wage increases. And because of that, people do have a lot of money to spend despite the rising prices. So they're deciding where to spend the money. And they're going to be winners and losers in this part of the cycle. The items that people still want to spend money on despite the price increases, they're going to spend the money, and they're going to cut back in other areas. So if you get into different sectors of the stock market, you want to keep that in mind. Buy those sectors that do well when the economy is turning down, and avoid those sectors that depend on high growth or a lot of liquidity in the economy and the markets. But the key point here is that we're now past peak. How long we're in that period or how close we get to a trough is going to depend on the Fed. If the Fed is serious, as I said, about getting down to a 2% inflation rate, it's going to have to really cut back demand in the economy. It's going to have to keep raising interest rates as it said it would and bring us down there. On the other hand, it could be that these current Fed officials, while they're talking a tough game, once unemployment starts to rise, people start to complain, they might decide that inflation rate of 4 or 5%, perhaps as low as 3%, is acceptable, and they might start easing up on monetary policy. If that's the case, we're going to be in a period like the 1960s, 1970s, where we had stagflation. We had modest economic growth, and we had above average inflation. And the longer and above average inflation stays in the system, the more it becomes embedded in people's investment decisions and people's business decisions. They come to expect it, and it gets harder and harder to wring out of the system. So where we go from here, it's going to be depending on what the Fed does. Watch the indicators I've given you. Don't particularly listen to what they say, but look at what they're doing in the monetary base and the interest rates in particular. Now, as I said, this is the data, the analysis I go through in Retirement Watch each month in the issues. It's what made us get out growth stocks very early. We added inflation hedges in 2020. Moves like that are all based on this kind of analysis. And because you're watching us on this special presentation, we're going to give you a special offer on Retirement Watch, a very low price with a lot of bonus reports. You get access to the website, which has all my back issues, the back articles. You can look back on everything I've written for some time. As you might be aware, Retirement Watch covers a lot more than investments. It covers really all the financial aspects of your retirement, whether it's estate planning, annuities, income taxes, long-term care, how to get the best deal on Medicare, whole range of other issues. So it's really quite a value for the price we charge, and Rogers decided to offer a special price at this presentation. Roger, you want to add anything to that?
Yeah, no, it's just you'll get a monthly newsletter. It's just 16 pages. 8 pages is all about what's happening in the stock market and his portfolios, and the other 8 pages is all the other aspects of retirement that Bob just covered. It's information that you really, you really can't find this stuff anywhere else. Bob is unbelievably good at knowing what is affecting your retirement and makes it very easy and clear in his writing. So it's a terrific value. So yeah, click on in the chat box. We have the special for only $77 for a year, and you get a bunch of some bonus reports and everything as well. And as Bob said, you get all the back issues and just everything's there. So it's another good bargain. Today we with the special all day event that we're having, we lowered our prices on everything, and no difference on Retirement Watch. So
in addition to the monthly issues, you get a weekly email where we update things happening between the issues.
Yep, and that's a good economic what's happening, all the stuff that Bob just covered today, you're up to date every week on that. That comes out via email every week. So it's a great offer. And yeah, press the link in the chat box to take advantage of this. And I don't know, Bob, anything else you want to say to everybody?
Well, I think while the markets are very optimistic about inflation coming down quickly and the Fed changing policy, I don't see that. I haven't seen that really for the last 12 months or so that people have been talking about that the markets have reflected that. So I think rather than looking at the headlines and the wishful thinking, you should look at the data, look at what the Fed's doing, and I think you'll see that we're going to be in a continued period when financial assets, stocks and bonds are not going to do particularly well, and you want to look at other strategies in other asset classes.
Yep, and Bob will walk you through that, and I think that even makes it more important for all the other things you cover and how to get best avoid taxes, and so when to take Social Security and all those other things you talk about when the markets are in a difficult time like this. All that other stuff is even more important. It's already important, but it's even more important. So click that button to get all that information for only $77 for a year. Terrific bargain. So, well, Bob, thank you so much for closing us up on this awesome day that we've had today. Thank you for joining us, and yeah, I hope everybody had a wonderful day today. I think it's been it's been an awesome day. I've learned so much today from all our presentations, and I hope you have too. And thank you for either being one of our subscribers or Please subscribe to our YouTube channel by hitting the subscribe button below the video right now. And I wish everyone a very profitable day. Thank you.
Aye.